Friday. We made it, Scotty Byrne.
Goodness, how you've done a whole week juggling all of this. Third day, and I'm absolutely beat down. So, yeah, I don't know how you managed it.
You are a superstar. I have to say, it has been an adventure. Wouldn't have done it without Scotty. This morning, woke up to unfulfilled Uber again. I thought, you know what? I'm going to march to the to the bus stop. Bus stop had all the buses delayed. And I walked to the station. I did. I walked to the station. I feel a bit fitter for it. Thank you. My heart felt like it was going to burst. But that's another matter. I got on the train. I managed to get on
That is epic.
the train. How was your journey in?
Well, I mean, I feel in comparison to what some of the journeys that people have had, mine is relatively straightforward because it's just one train to Liverpool Street and then walk across. But it's actually been really busy all week. I mean, my train was packed this morning. And that's the 6:10 or whatever it is. Absolutely packed. But yeah, Liverpool Street, I think they've got a partial service on the tubes running. But again, teeming with people. So yeah, I think it's been a tough week. It's been a tough week for people having to travel in. I'm just being told by Jugger my volume is low.
Good morning, Jugger. Good morning,
okay.
Boise. Good morning, Monkey Man as well. Are you in the downward dog position? He does yoga whilst he's listening to us.
Impressive.
And I don't know how you trade at the same time, but you know, that's another story altogether.
It's all that Zen focus though, isn't it?
Then, yeah. We're going to have Issar, speaking of Zen, up with us at 8 o'clock to talk about loads of stuff to do with Zen and trading psychology, as well as join Scotty on the Open. R. Sachs, good morning. I have a special R. Sachs is very interested in defense as well.
Excellent.
Otherwise
there's
known
a lot, as we know, there's a lot to talk about there because you've been very busy this week outside of organising people, filling in guests, purchasing greenery and everything else. So, yeah.
Gavin, Freitag, good morning to you as well. And Steve, CDR. Right, let's quickly get our viewers across the coming up. If we may, do we have a shot for that? We'll just talk them through the coming up because we've had obviously lots of discussions over who's going to be in. I had a plan A, plan B, plan C, and possibly plan D as well. That's Andrew the Sock Puppets. So coming up, we got Issar, as I said.
Yep.
And then we got Garth McKinsey as well to talk us through all things markets and crypto. So if you're into Bitcoin, Ethereum, Solana, do join us for that. And also we've got that special interview with Pulsar Helium.
Brilliant.
A bit later.
Look forward to that. That's going to be really good. That is going to be really good.
Right. Overnight. Let's go to overnight action, shall we?
Yeah, let's see what's been going on.
Let's do that. Hey, welcome back to overnight action. So what caught your eye, Scotty Byrne?
I think for me yesterday, the market has been, the US market has just been struggling to really have any impulse. So the last few days we've had one or two indecisions on the charts that we kind of highlighted on Tuesday as well. Doesn't really look like it was going to push on. But then yesterday, an inline or kind of flat month-on-month weekly jobless, and then a flat CPI. The month-on-month was slightly up. The market just reacted in a pretty wild way, to be quite honest with you. You know, another new high, but the breadth has picked up for the first time in a while, which is quite interesting. I'm going to keep talking when I just bring that up. But yeah, I think it was interesting to see things like the Russell up 1.5%, the equal weight S&P up 1.5% yesterday. So that to me was quite interesting. So let's just bring that up. So you can see here, so it's a slightly messy four screener, but basically we've got the 50-day and the 20-day breadth on the left-hand side, the 200 down the right, and then the put call ratio on the bottom right. I mean, you can see that's a pretty significant jump, having trended lower. Whether that pushes on today on a Friday where you've made another high where there's not a lot of data around, I don't know. But into next week's Fed meeting, which we can obviously speak about on Monday anyway, but there's going to be a press conference, there's going to be dot plot forecasts as well. That to me I didn't think the numbers were going to be that great, but on an ironically softer jobs number, the market took off. So yeah, for me overnight, that's been the real feature.
And also, interestingly enough, there's been a huge silence, I have to say, huge amount of silence over geopolitics, considering what's happened this week. I find that more peculiar than anything else because, you know, we have this rising expectation of a cut from the Fed, right?
Yeah.
Gavin Ackers and I were talking about this on the show. We had a poll. Many of our viewers still in the 25 basis point cut camp, but Gavin and I kind of felt, you know, 50 might not be too far of a stretch. Where do you sit, Squashy?
I would be, as I was chatting about this with Axel on Monday when we were looking at markets, and I think 50 would be seen as a little reckless, but again, I mean, I don't know let's go to our friends at Polymarket and just see if there's much of a change in the expectations of that. But yeah, while we're just bringing that up,
yeah,
I think that
whilst you bring that up, look at the US 500. We are starting to see a bit of plateauing. This is the daily chart here. Also on a Friday, just be aware there might be a bit of profit taking. Volume certainly early on looking quite low there. Also crossing over to the Forex markets as well. You know, US dollar basket still pretty much flat there. So it's looking a bit like a wait and see until we get to the Fed. But as I said, you know,
that's what surprised me with that jump yesterday. That was a proper jump yesterday when, as you say, 4 working days away from the Fed meeting. But yeah, I mean, look, if we go to Polymarket, we've still only got 11% betting on a 50 plus bips decrease. So yeah, I think the difficulty for Powell is, and we have touched upon this already, where he was criticised at raising rates too slowly in COVID because he was so focused on the jobs data. Is he going to be, it's a reactive human function to not want to be accused of the same thing more than once. So I can see why, or where some people are arguing for 50 basis points. Again, I don't think anything merits it looking at where asset prices are.
Yeah, and consumer prices as well, rising more than expected, right?
That's correct,
that's also, you know, not, you know, giving any of that sort of support, that call for 50. But there is this still 7% chance of a deeper 50%.
Yeah, I don't think the market would like that. I think that would have the opposite effect that...
something's wrong.
Well,
right?
This is it.
Beep,
This is
beep,
absolutely it. Especially as well, anecdotally, as we were discussing as well the other day, how Fed cuts normally precipitate a market sell-off, or they certainly have anecdotally in the past. I think 50 bips would be pretty tough to justify when you look at his stance since about March of wait and see. So yeah, the data is not really suggesting it needs 50 apart from the jobs number, but I guess we'll see. That's why he's in the big chair and we're in the discussing it without the pressure of those decision making.
Yeah, and without any, you know, summons as well to kiss the ring. I've been hearing loads of chief executives, you know, around the country in the US being summoned in the coming months, and they are all in strategic sectors. So now that Trump has met with, you know, all the usual suspects in the tech space, he's moving down into commodities and rare earths and things like helium, for example.
Why do you think he's doing that? What makes you...
To ensure that they know, you know, the line of command, yes? So that when the orders come down, everyone knows what to do. Much like Angeline's plan A, plan B, plan C for strike
absolutely.
week.
Yeah, absolutely, yeah.
This week. Let's just quickly remind our viewers as well of what happened overnight. Micron Technology, of course, one of the big movers in the previous session. This is after Citigroup. This is 5-minute chart here I'm showing you of Micron. Look at that move there, jumping more than 7%. Wow. Citigroup raising its price target on the memory chip maker to $175 from 150. Of course, it's now 151. And then Warner Brothers Discovery. Were you watching that yesterday?
No, I'm not a big watcher of that, to be fair.
So Warner Brothers usually are really sort of dull, not
Yeah,
really
that's what I
talked
mean.
about.
It's not. Yeah, I just never.
Yeah.
Never look at it.
I have to say, at the risk of showing my age, I still have a T-shirt of Warner Brothers and Turner and CNN all meshed into one, and it was all left on our desks when we got to work. And we were also given, share options in all those companies. And
wow.
all of us kind of like banged our heads on the table going, they know we work in finance, right? And they know that, these options, and we're looking at the share price, and it's sunk below now. So it's not very attractive. But anyway, back to Warner Brothers. It surged 29%. This is on a report that Paramount Skydance is looking at a majority cash bid for this embattled company. So
Wow.
just showing you the daily chart, just show you the significance of that move. And I always say, look left. We're now at levels not seen since August 2022. And if you go further out as well, going to the weekly chart, friends, here, and also the monthly chart, you can just see, what a move that
It's a serious
was.
move, isn't it?
Yeah.
And the streaming platforms, I mean, again, where you look at I'm sure like most people nowadays, smart TVs are very affordable. So when you go to your apps menu, all those providers, there's got to be a bit of consolidation there. And you can see a lot of the cross-selling now. If you go into Amazon Prime, you start getting Apple TV streams on there. So, yeah, you can see the direction that's going. But speaking of looking left, actually, I did think this is one we haven't spoken about for a little while. Tesla.
Breakout and touch me.
Well, yeah, because when you think we haven't, it's what, a month since we spoke about him since numbers?
Yeah.
And it just goes to show silence is golden, right? When he doesn't say too much.
Up, Musk.
Basically,
Shut up.
When he doesn't make too many pronouncements and quietly gets on with, I guess, his day job, which he might be getting paid $1 trillion for. So I guess that will probably draw the focus in. But yeah, look at that. I mean, as I say, we love to look left, and rightly you've highlighted just the top of that candle there, and look at
that breakout, people. Look at that breakout. I did tell you that was an area of interest. This is a daily chart.
Yeah.
And for technicians, it's all about the the move, the breakouts that we're waiting for. I did say that there was a lot of upward momentum there. We're seeing the untangling of the moving averages, and it was starting to show that rainbow formation, which we like to see with the price action sitting on top. And there we go, we had that breakout.
Lovely.
A lot of chatter overnight as well amongst the trading hub and the investment hub here at IG internally. But also I saw quite a few on the Twitter sphere yesterday. I mean, they have a huge following. So as I was going to bed, lots of that coming through on my mobile phone, pinging away. Pelican, good morning to you. Pelican saying, can you look at Open Door, please? Let's have a look. We can indeed. Open Door Technologies. Here we are. Look at that move higher. Mo is a big fan of Open Door Technologies. Is this one that you're familiar with?
I'm pleading ignorance on this one. You're going to have to enlighten me on this.
So Open Door is one of those companies that allows lots of different companies to sort of gain insight on their data, and also they have clients like Shopify, and they've got a new CEO, of course, from Shopify as well. And Open Door, his name is, I can't say his surname, Najatian, I hope I'm saying that right, Kaz Najatian. They bring him on board to try and triple the share price of the real estate tech company. And the thing that is interesting about the stock is, unlike Mo, who is very brave, Pelican is Mo. Mo is Pelican. I like to stick with areas that I am au fait with. I have steered clear of this because I'm not so au fait with this sector. It has very good momentum. And Pelican is a true momentum investor and trader. So he also looks for these signals and volume and moving averages that, you know, how we see a consistent uptrend, because don't fight the trend, right?
Yeah, I mean, look, that's a great chart, right? I mean, irrespective of if we understand the business, you can certainly see why it attracts as well if you're a momentum trader.
Yeah. And here comes Ange's but.
But
I am also aware that Open Door has been described by some as a meme stock. And so it tends to also get powered by a lot of enthusiasm, shall we say. So
I would guess it probably belongs in the cluster of stocks that you could bracket that under. But I mean, that's a pretty steady grind upwards. I think that's perhaps a little harsh, although again, because it's suddenly started picking up, which is if you look left, if we draw back and look a bit further left, it's just not been doing a great deal for a long time. So there is a sudden explosion higher in it. So yeah, interesting.
Maybe Pelican can tell us as well, because I don't quite understand. And I'm a bit like Warren Buffett. If I don't understand it, don't touch it. So the Open Door has this tech, and it's a bit like We Buy Any Car, or is it Car Supermarket? I've used one of those where you kind of like, I need to get rid of the car, get me the best price, use your algos, you know, and they look at numbers from auctions the week before and the previous week, depending on what model you're selling. So then they give you cash straight away. So Open Door has this technology that uses AI as well, and it tries to simplify the home selling process so that they offer instant cash offers on homes, you know, through its platforms. I don't quite know. I mean, like, I'd love to know whether they can navigate.
I've seen this now and again when you get these adverts here. I've never really.
Yeah. I don't know how they would navigate the UK housing market because it's so different, like from one road to the next.
Yeah, I did. And again, the speed of completion. I did see a very quick thing about the UK housing market in the Times yesterday, about the speed of conveyancing and how it's got like 30% slower every year for the past 5 years.
Yeah.
So yeah, I mean, I'm in the process of selling a property at the moment, and it's just painful.
Yeah.
It's just absolutely painful. Anyway.
Yeah. So Pelican, if you can enlighten us as to how they do this, I would love to know, because I don't quite. And also apparently they deal with all the conveyancing. They can, and super fast. All of this, they've gone through this process, know that it's not fast.
Yeah.
In this country. How would it deal with gazumping? That's what I want to know.
Yeah.
Speaking of which, loads also out today. Of course, we are also counting down to some more B-list data, but you know, who knows? It might prove to be, given how markets are on this slow melt up still, that maybe this data might provide some sort of a move. We don't know. US consumer sentiment, of course, that is the UMISH, expected to show that US consumer sentiment is softened slightly in September.
Yeah. I think the 1 year, 5 year expectations number might be good, but since Powell basically said that survey data is out the window back at the March Fed, he's just been so fixated. It's actually had, I mean, that used to be a real mover, especially on a Friday, that Michigan sentiment stuff. But that's definitely eroded a bit since Powell said, as I say, back in March, that this is just not the kind of survey data that we look at, which I'm sure the University of Michigan is very upset about, with the compilation people doing all that work. But yeah, that's a little more. That's a little more frustrating. Also, as well, we got some more IPOs today. I know that you were watching Klarna the last couple of days, because that was very exciting. We can touch upon that as well. But Gemini, the crypto exchange owned by the famous Winklevoss twins, that floats today. There's a couple of other smaller ones, so that might be a bit interesting as well. But I haven't been looking that closely
20
at
times
Klarna since floating.
With Gemini, apparently 20 times oversubscribed.
Yeah.
That is according to finance magnates, but it'll be interesting to see the kind of appetite for this crypto exchange given we have this burgeoning or starting crypto wave again. Those of you that are watching this space, the expectation for Solana, your XRPs, your altcoins, Bitcoin and Ethereum as well, is that with the coming Fed cut, that's going to provide more liquidity into the market. And all that means for those that watch the crypto market is that it lifts crypto because the money has to find somewhere to kind of...
It will look for a home.
Yeah, look for a home. That's right.
In fact, as Rich likes to say on the Art of Investing podcast with these two market gurus, the competition for capital. Andrew, that's, I feel your pain. I feel your pain. That is...
See, Andrew, Andrew's like hit it on the head, like to tell me what anyone that said
the sooner it gets onto blockchain, the better.
It's not a fast process. So how will Open Door, for example, be able to navigate places where it's not a fast process and there's gazumping?
Absolutely.
Right. Who grabbed BAE yesterday? Let's have a look. BAE. Here we are. Look at that go.
Well, talking about BAE, surely that's a wonderful segue into, apart from your regular day job of markets, charting, interviewing, making multiple plans, you've also been at Excel this week, haven't you?
I have been at Excel. I am heading back there today because for those of you that watch the space, it is a 4-day event. It happens only once every 2 years.
Oh, okay.
I am going to show you some pictures. Terence has got them already. Let's see if we can bring them up. So that's the Anjural Pavilion near to where...
Is that a submarine model or?
It's kind of like an unmanned sub. I think that was what they were.
Like a drone sub.
What they were trying to explain to me. But it has the capability as well, obviously, for them to build out one that's got loads of capabilities to have people as well. That's H003. If you move on to the next picture, but of course, I was looking for it. I think at that point, Maturin was online with me, and I was like, I need to find Palantir just to see how big their stand was, and it was indeed much bigger than previous years.
That's what happens when you share samples.
So
you spend out
Palantir,
a bit more on the stand.
Yeah, they are the eyes behind defense technology and also the combat capability sequencing of the plan A, plan B, plan C. So you can use their technology to kind of simulate what kind of outcomes, what to deploy. So yes, okay. So Palantir had a huge stand there, much bigger than previous years. Can you see the number of people? Let's see if we can go to the next screen as well. The number of people there, General Dynamics, of course, that where the tank zone is, and they were out in force. The reason I'm talking about the 50,000 people, and I was there on day 2, and today is day 4. Day 2, it was so crazy. Restaurants are running out of food. It felt like a concert atmosphere. I could not, at some places, I could not actually see the carpet, which is a huge difference from 4 years ago, from 2 years ago. Let's go to the next picture. That's the land pavilion. And I went there specifically to be at the AI defense panel. But what was also interesting is the number of outfits there, including BAE Systems, by the way, which had a huge number of drones on display.
Right.
So clearly that's been a big thing this year. So drone technology and also anti-drone technology and combat solutions that are able to navigate what they call future workforce.
Got you.
Several questions, Scotty, that I put to the heads of different stands there. Sachs, you'd like to hear this because we have this theory that there's going to be increasing spend in Europe. However, what I found out was quite surprising.
What was that?
Well, the fact of the matter is a lot of the spend is already allocated. Number one. Number two. They don't quite know why. They think it's somewhere in admin, but the spend that's been allocated don't seem to be getting to the boots on the ground. And certainly the case here in the United Kingdom. That is the overarching mood music. Number 3, the consensus is perhaps the boost that that has seen happened earlier this year already. And maybe now the growth is in other areas like Indo-Pacific, perhaps. We do know that Han ETF and some other outfits are launching defense ETFs and funds that are looking at other regions. That could be why. But also the interesting thing is that there was a lot of talk around capabilities surrounding response, surprisingly, from the NHS. Whether or not the NHS are ready. We had similar music in France as well. Are systems that support, for example, our health system ready to cope with something that is unexpected?
Yeah.
That was surprising too, because I didn't expect that the mood music to be surrounding that. I thought the mood music would be around Article 4, Article 5, because of the drone strike earlier this week, right? But no one seemed to be talking about that. Everyone seemed to be talking about capabilities. Interestingly enough, I caught up with some fund managers and also the words tactical deterrence. We're invested in tactical deterrence. Some of them even saying that you need defense in sustainability. So you good. We'll leave.
To take on board,
we'll leave you to take that on board, because right now we've got guess the chart. Now, if we got new music? We got new music.
So good.
Here we are. So guess the chart. Is it UK or US? It's the US. Wow.
It's a repeat of yesterday.
Yeah, because
nobody got it.
Yeah.
We're doing that, are we?
We're doing that. Right. No pressure, people.
It's down, everyone. Come on, it's Friday. TGIF, last push. Let's
come on. Done. Let's get this chart. Here we go.
The chart, she whispers. But does she tell the truth?
Step by step, I trace your line. A flicker red, a candle fine. You lead me up, you pull me down. You wear a bull's face, then turn around. Guess the chart, mi amor. Is it pain or is it profit I'm dancing for? With every tick I lose control. Your side raised glance devours my soul. Producer Phil plays coy. He shrugs while Rich is hedging all his plugs. But Ange, she sees, she knows the game. She whispered short, then lit the flame. A wick, a gap, a silent fall, a fib retracement, or none at all. The RSI is on the brink, but I can't move. I dare not blink. Guess the chart, mi amor. Is it pain or is it profit I'm dancing for? With every tick I lose control. Your side raise glance devours my soul. Guess the chart, take the lead. It's love or ruin in every feed. No safety net.
Hey guys, we are back for the opening bell. Hamish has saved us with Bill. loved how the music this time started slowly, but then builded to almost like something out of a Tarantino
Yes.
movie. I thought very dramatic for a Friday.
It was very dramatic.
for a Friday.
I wanted
really
us to
thought it
come
was,
back
yeah.
in the yellow jumpsuits.
Ah, yes, that's right. Maybe, or the black suits with the black ties and white shirts. Right. Anyway, 5 seconds to go
Oof.
till the peak of the day.
Boise saying, hey, hey, hey,
There we
so
go,
here
there
we
we
go.
go.
And we are off. It's looking a bit quiet there, cautious, but to the upside for Germany and also for the FTSE. Let's quickly have a look at the FTSE. There's some still at autumn, but we have taking a look at and zooming in. Scotty, any of those pop out at you?
Fresnillo again. That well, as silver's already been mentioned pre-open, Fresnillo's definitely riding that horse higher. The miners, not surprisingly, pretty strong with rate cuts being a bit of a tailwind for commods. Home builders as well, Beasley, Barrett's, Rightmove. So in spite of the snail-like conveyancing process in the UK and the very much lack of an open door type company, UK real estate as well.
Yeah. Here we are. I kid you not, I'm just going to swap over. I kid you not, I have been out of pocket by 1,000 before by conveyancing because the vendor, the person I was trying to buy from, jumped out of his back window to avoid the fact that he was pulling out after he'd said he would sell. So there you have got quite a few.
He literally jumped out.
He jumped out the window, and the estate agent and I stood outside watching it, going, no idea what's just happened, but that doesn't look good.
Yeah, extraordinary.
Yeah.
Extraordinary.
And so we just had to cut our losses, or cut my losses, and move on to the next property that we were going to buy. Here, downside, BP down 1% there. And also Shell, so a bit of softness there for the oil majors.
No real shocks there, I
surprise,
guess. In the pretty Rolls-Royce, I mean, that's not really a move in Rolls-Royce, but interesting to see it back above 11 quid after a little dip below, which is good. Yeah, it's quite a mixed bag, really, isn't it? There's not, it's pretty, you're really kind of scraping to find any real underperformers there, aren't you, in those outside of the energy names and a couple of other defensive things like Staples and the pharma names. I
wonder if it's all being tempered by the weaker than expected industrial and manufacturing production that came out of the UK July month-on-month GDP data this morning. That was slightly offset by services and construction. Of course, ECB also left rates unchanged. But let's have a look over at Germany, the Germans, jugga. Right, here we go. So here are the winners first.
Yeah, again, that's another little cyclical push, really, for the most part, isn't it? Infineon, Siemens, Rheinmetall, Heidelberg's, Brenntag. That's that other push higher again. Rheinmetall, I know that's pretty well held, and that's a favourite for some of our viewers too, and rightly so. But I was actually looking at the indices. And the DAX is actually has very quietly drifted to about 1 month lows. It's really not showing that same impulse as it had, as we were talking about front end allocation of some of the defence spend. Maybe just for now that tailwind of defence spend has perhaps petered out a bit because the DAX was an absolute joy to trade for the first 6-8 months of this year,
yes.
But that's kind of slowed down a little.
It has,
which is interesting. And yeah, and after the ECB yesterday, I think Lagarde spent most of her speech focusing on the support they can give to the bond market if France were to cause consternation amongst other investors. There's obviously been some selling of French bonds, so Lagarde was more concerned about protecting the bond market, and they've pretty much signalled that rates are stuck at 2%. So yeah, some of those tailwinds perhaps petering out a little bit.
Do you know what I found most interesting about Lagarde's speech? The fact that she, I think, implied that inflation indicators are consistent with the bank's target. I mean, this all plays into the whole, is 3% or 4% the new normal?
Yeah, I mean, she has done well. There was a stage not so long ago, every time she opened her mouth, the market used to collapse, the opposite of the Draghi effect, where every time he used to speak, it used to go up. So yeah, that's certainly got
That's a bit unfair though, because Draghi just droned on until everyone went to sleep.
No, that's true. That's true. But unfortunately, you're judged by the market performance when you open your mouth. So as a
Yes.
politician or central banker, you are judged by market performance, as we are, And yeah, a little bit of cyclical weakness. Airbus, Porsche, Adidas, Volkswagen. Again, just a little off the top in those autos names. They're probably, as we were talking, in a bit of a range, as you were discussing with Ronnie the other day on the show, just about where the auto market is in Germany.
Right, moving on to France very quickly, because I know Issar is about to come on and we don't want to take his precious
Chomping at the
time.
bit.
Yeah, chomping at the
Chomping
bit. ST Micro, Thales up more than 1% there. Bouygues as well, up almost 1%. Any of those you like?
No, it's to see Bouygues, it always used to remind me of a colleague of mine in New York who used to torture himself trying to pronounce that in various different ways apart from the correct one. So yeah, I do feel sorry for him. But yeah, again, look, largely cyclical, banks up, industrials up. That's pretty much mapping across from that US move yesterday, as we were talking about factor trading that algos like to do from the open. There isn't really anything there that's making me think that shouldn't be there. Stellantis again for cars, a little bit of that weakness, energy weakness. It's predictably dull and tracking each other, which on a day like today, after a week we've had, probably not a shock.
Yeah, probably not a shocker at all. We are going to have Issar coming on, so stay right there. Keep the volume up because Issar's back with us for fast markets and, of course, a bit of trading psychologies too.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, the fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hey guys, welcome back again. Thanks for your patience. Issar and I are doing fast markets. We've already been discussing.
We've already chatted, yeah, it was
some
great.
of the brain mangling aspects of the market currently. So we'll touch upon again, much like the section with Elliot as well the other day, where some of what we talk about will hopefully will trigger a few questions.
Yeah, and I think a lot of it.
Yes, so feel free to chime in with anything, because that was great the other day actually how to bounce off the questions. I appreciate it's Friday, everyone's quite fatigued.
Well, I was going to say, the other thing is it's quite nice because a lot of what we're going to talk about feeds directly into next week.
Yes.
I think so. I guess we were talking before the break ended about yesterday. And I think yesterday was a kind of crazy macro day in terms of like data reports. So we had slightly hot CPI data, and we had kind of cooler than expected job numbers. And the market seems to just be a bit confused by it all, and seems to actually just be kind of gently continuing its march upwards, or in some cases not even that gently.
It felt a little bit like me, whereby sometimes having sat and run positions in the past, you decide this is a watershed moment.
Yeah.
Everyone says it is.
Every CPI report is the most important CPI
Exactly,
report.
everyone is most important since the last one and until the next one.
Yeah.
And so it was almost like people just sat there and said, unless this is absolutely blowout either way,
Yeah.
and creates real volatility,
business as usual,
I'm just
right?
going to hit the return key and send orders into the market, because that, as we've already mentioned on the show this morning, the breadth, the jump in breadth and that performance of the equal weight S&P.
It's kind of nuts.
And
yeah.
the Russell, where jobs numbers are coming down.
Well, exactly, and I think we're in this kind of bad news is good news, at least from a jobs market perspective, which is also a bit confusing, in part because we've had some quite bad jobs numbers between the claims data yesterday, the kind of jobs data last week. We had the massive 900,000 downward revision to jobs. And so I think what you're tending to see is that actually maybe the labour market's a bit weaker than we expected. It's not radically weaker. And so I think if we were to see like extremely concerning numbers, then I think the market would respond a bit differently, but they're all a bit softer than we expect. A lot of the revisions tend to be in one direction.
I can only imagine if at one of these, surveys, or particularly in non-farms, if you get a negative number.
I think that's where that will be, I think, a bit of a crystallizing.
Yeah, I was listening to a piece the other day where I think it was quoting Neil Kashkari saying the kind of number they like to see is about 75,000 a month.
Yeah,
So
that's I
that's a
think
replacement.
what his like replacement rate.
Yeah,
is right
exactly,
now.
his replacement rate. Thank you. Yeah, so 22,000 as a one-off.
Yeah.
It's
a bit
just,
soft.
it's soft, but it's just a case of,
Yeah.
and look, I think it's clear that Powell does focus on jobs.
For sure.
As we saw in COVID, and as we already mentioned, the criticism of him.
Because if anything, he was too focused on jobs.
Too focused on jobs, but that's clearly his whole angle, because it's the variation of inflation, and they still don't know the real tariff impact. But with everything that's coming through, like the PPI data the other day, that was.
I mean, that was cold. It was PPI this week was like extraordinarily
that's
cold.
generally one that people ignore.
Yeah, well, but last month's PPI was super hot. So we're kind of coming off this quite noisy signal, and part of it is because businesses are trying to respond to tariffs. A lot of those tariff news have been kind of a bit, I saw an economist describe it as like the hokey pokey, where it's like a bit in, a bit out.
Yeah.
You shake it all about.
Well, and I just think in general, as we say, I mean, look, we're obsessed with looking at trends.
Yeah.
I mean, if you drew a line of averages, if you had a number of all the data, and things like the City Surprise Index, and the Atlanta data is actually looking pretty good.
It is positive, yeah. And so I think we're just in a slightly odd position, right? People don't really know what to read, and I think you're getting quite noisy short-term data. And so while people are trying to absorb all of that, plus understand what's going on, I think there is just a gentle upward bias in the market, and I think that's quite as much as I'm sometimes quite bearish, I think there's quite a rational response to what we're seeing so far, because we're likely to see kind of gently easing rates, at least in the US. The US is like relatively stable, I guess, compared to like France or somewhere like the UK, where growth is like very
for
stagnant.
some of this money, as we were talking about money flows, as we know, those are king.
Like, where's it going to go, right? Yeah.
Is it going to go back into the US? Well, speaking of rates and jobs, we've just been asked a couple of questions. I realise this is just a fraction away from the US, which is probably a bit of a welcome break for people, because we've been asked to take a look at Crest Nicholson,
nice.
The home builder. So let's just bring that up.
Yeah, let's pop them on the screen.
Yeah, let's just get them up. Okay, so yes, a double, arguably a triple bottom.
Wow.
Just looking at that there, but those are. I think the problem is for things like house builders and rates.
Yeah.
I think you could just see that's really interesting.
Do you know what kind of regions they specialize in, or are they like fully cross country? Because we're seeing some quite interesting like regional differences in the housing.
Yeah, I must admit, I've lost my thread on, because I know Barclay Group's mainly southeast higher end. I think Crest seem to be, so they're building. When I see adverts for Crest, they're building new developments in places like Cambridge.
Right.
So probably they seem to go for the more higher growth areas. I think
very biotech and kind of AI focused.
Yeah, they're trying to look where the pins on the map are going to experience a bit of growth, I think. And so, yeah, I mean, again, it's certainly formed a double bottom, but this is a little bit like when Andrew was talking about Lulu on Monday to Mr. Wheeler, where just because it's behaving like this
doesn't necessarily mean.
No, I don't think it's necessarily a signal. I mean, it's so far from its moving averages.
Yeah.
I mean, look, that's not to say that it's not a tradable stock. It clearly is. But if you just look at this as sort of a soccer match, and on my screens the yellow is basically a red candle and the blue is a green candle. If you take from, say, August, it looks as if the sellers are winning the football match about 15-2 at the moment. So yeah, it's certainly formed a base, a little like sterling that's holding in. UK markets are holding in.
Data for the UK is a bit confusing for like home builders, right?
Again,
because you've got you've got no growth as of this morning, but at the same time you've got potentially rates coming down. One of the big concerns with rates coming down in the UK is like the UK housing market has been basically frozen in place because no one wanted to sell.
Yeah.
And so as rates start to come down, you might actually see inventory go way up and the market kind of unfreeze. And that actually might be quite bad for home builders because the stock of kind of new homes relative to kind of existing homes on the market might shift a little bit towards those existing homes.
That's very true, yeah. Yeah, that's very true. You say most people want to move from an existing housing stock for a particular reason. It could be downsizing, schools, all the normal reasons that you move, but they're not necessarily rushing out and spend their hard-earned savings on a new property to
unless
get on
they have like a good reason, right?
Unless they have a very good reason, yeah, absolutely. So yeah, thank you for flagging that. That's a good one to look at. I haven't looked at. I mean, let's as a comparison then, for argument's sake, look at something like a Barclay Group very quickly.
Yeah.
Helps if I actually spell it properly, because otherwise my machine's not going to know what I'm going on about. So yeah, Barclay Group, yeah, again, a bigger gap down in the summer on that pricing shock, but they're not in terms of the shape that they're making.
It's not quite as...
They're troughing, but it's look, it's one to watch, but again, at the moment, unless, and as we were talking earlier on this week, maybe with the changes again on the political front, Starmer...
Well, he wants to build, right?
Well, and you know, Starmer looking to bring Blairites into the front bench, more of the pro-growth rhetoric.
I mean, next week we're supposed to have all of these tech companies come with Trump to the UK and declare a bunch of growth things.
Yeah, well, I did see there's a data centre that's getting open. So yeah, I mean, again, I think with the expected reaction function around a visit from the president, especially with what's going on at the moment, the media is going to be taken up with that, unfortunately.
Yeah.
But yeah, I think definitely make sure you check the business press and not social media just to see what things are getting inked.
Yeah, 100%.
What we should be looking at.
And I think there have been some reshuffles actually, even in like who the ministers are in the Starmer government. And one of the things that has been relatively stable actually is the degree to which they're quite bullish housing and they want to kind of clear out some of the planning reform. So I think this is one of those like long running themes that really impacts the kind of house building kind of segment quite a lot. And I think if we do manage to kind of clamp down on a lot of those planning reforms, I think that will be really bullish for the sector.
Yes, absolutely. I mean, having got a few friends who work in that space, the lack of skilled labour.
It's crazy, right? Yeah.
Again, is a problem.
It's huge.
This is the argument I've always had about the size of the internal market and flexibility of the US. If you're a carpenter in Idaho and there's loads of work in Florida, you just kind of throw your stuff in a U-Haul.
Yeah, it's not too bad, right, to me.
No, that's right. And and unfortunately, the actual labour and the exterior outlook, perhaps, that's getting projected by the UK is not of, hey, come work here,
come work, right?
Pay more tax, and especially if you're from another country, you're going to get made to feel really welcome, you know. So yeah, that's certainly not helping.
Yeah. Do you? It's funny you mentioned Lulu. Do you know this like running bet that Ange and I have about Lulu and?
No,
so now 4 months ago, Ange and I had a bet where we basically did opposite sides of a pairs trade. And the pairs trade was Nike versus Lululemon. Today I'm wearing some Nike trainers. I'm bullish Nike relative to Lulu. She's very bullish Lulu relative to Nike. And I think it's been like an interesting one to watch, because I think there's such a weird demographic balance happening in the US, and where consumers are choosing to spend their money is like being quite radically shifting. And I think you can see some of these stocks like Lulu, which were priced quite richly, like at the height of their valuations, I think starting to come down. And now, honestly, I look at Lulu and it looks pretty beaten up.
Yeah, I mean, it needs a proper
Yeah.
reshift. Although, again, a little like Nike. I mean, I remember Rich months ago saying about Nike and the and things like On Running and those other brands. I mean, things are salvageable and they're still a brand, but they seem to be at the moment. For instance, one of the kind of interest groups that I know from it is my daughter and her friends. They just like the brand, they like the whole kind of shtick, but 17-year-olds don't really drive your bottom line in
That's
margin.
probably true, yeah.
They
you
wait.
want the 20 kind of 6-year-old have income segment.
Yeah,
right?
who work on Wall Street,
Yeah,
who like to
yeah.
come in yoga gear,
Yeah,
which was
exactly.
their whole demographic. And so interestingly for Nike, then you're talking about some of the shifts for consumers and so on. What's been really kind of striking you about that shift compared to say a year ago?
So I think there's a couple of things. I think number one, I think they had lost touch with the running segment, and that was a segment that actually drove.
Really, that's interesting.
Yeah, and that had really driven a lot of the brand strength. And I think if you look actually in general at the kind of high performance sports segment, like they weren't doing quite as well in basketball, they weren't sponsoring as many athletes in things like athletics. And so I think Nike had kind of shifted to a leisure brand more than a high performance sports brand. And then they were getting kind of eaten by, exactly like you say, players like On, who are then trying to appeal to that running segment. You've got specialist players who try and kind of appeal to different sports communities. And so I think like that's painful. And then on the other side, you have people like New Balance, who, while they had quite a big running segment, also pushed very hard in the leisure segment. And so Nike was kind of getting eaten from both sides. And they brought back some of the old management. They're doing some kind of changes in how their business works. I think it's, in my view, quite a like back to basic strategy. But actually, that's quite appealing.
I guess with the Olympics,
it's a huge opportunity, right?
Coming as well, then that's all of a sudden, now's the time to pivot.
Yeah, and I think also now is the time where you can see a lot of these players taking quite big swings. So if you look very simply at like the Adidas Liverpool deal, where Adidas are like fully sponsoring Liverpool Football Club, and Liverpool have re-released their shirts this year and have sold more shirts than they've ever sold before. In fact, the Liverpool shirt sales from Adidas kind of sponsored kit is more than the total they've net spent on players this transfer window, which is mad, right? Because they've really... Yeah.
So I'm not a big football guy, but I do identify Liverpool and Adidas really closely, because at the times in the 80s and the late 90s, they had their success. They
exactly.
Adidas.
I think Adidas being like really tied to the brand. I think the other brand that Adidas has been tied to over the summer at least has been Oasis. And I don't know if you went to an Oasis gig. I would
love to have gone, but
I went for one of the gigs. I was like delighted to get tickets, but like I went and it was just packed full of Adidas gear. Like people wearing Adidas hats. It was like fully like the 90s vibe, right?
Proper nostalgia.
Yeah. And like it felt very clear to me that like, oh wow, I think Nike just isn't in the zeitgeist at the moment. And I think to rebuild that credibility, they really do have to put in some of the basic work.
Yeah, it's got to go back to sports, isn't it?
Right, exactly. Yeah, and I think it's high performance sports that I think really sets the culture for that world. And I just think that they had been really lacking in that space.
Yeah, I completely agree. Right, Pelican with those wonderful pink high five hands to get our attention. That is a very good use of the icons there in YouTube. Quite a strange set of icons in YouTube, but there you go. I guess they've got their reasons.
They also look at Robin Hood, right?
Yeah, absolutely. Yeah. So Robin Hood. So yes, we've.
Wow.
So yeah, look, now this has been accepted. I mean, look, some people who like Robinhood as a platform, now they've been accepted into the S&P 500, might see them as a sellout, and they don't want to trade.
It's not their fault. Their market cap is.
I know, but that's how the meme crowd, I guess, move. I mean, again, look, a great performance, as Ange likes to say, with her rainbow methodology. Again, that's almost a perfect move higher. So yeah, much as you'll see on these index inclusion names, I mean, if you trade this as a a momentum play, as an earnings play, anything like that, you probably want to avoid it for the next week.
Yeah, it's just a bit noisy, right? And
It's far too noisy, because what will happen is now from when they were included, I think the inclusion announcement came several days ago, hence the pop higher.
Yeah.
What you will now have is a lot of the banks and funds out there are calculating
when to
how many shares
rebalance.
Exactly, when to
and
rebalance,
how,
should we go early and how and so on. So that's why you're seeing that really weird price action. So I think you almost need to suspend your trading in this, because you can get caught out, particularly on the day.
And there are like specialist shops that only trade index inclusions, right?
Oh,
and
no, absolutely.
It's crazy sophisticated.
Yeah, I mean, some of our teams at Credit Suisse, all they do, they literally have mass doctorates in just to do the forecasting of these stocks. And they'll be trading something like that. I think because of the questions around Robinhood, and it's failed a couple of times, it's probably been less clear. But you might have had some people who've had this position since June.
And just knowing,
for an index inclusion.
Yeah.
So I would certainly be really careful there. Just trying to trade that from a visual basis and what the price action does, because you can get caught out.
Yeah.
And open interest in options trying to start coming back in October. I mean, I don't think it ever really goes away. Pelican, you might remember when we had Elliot on earlier on in the week, the usage of options has more than doubled in the last several years.
And the days to expiry of those options is
0 days to expiry, So things like open interest, the difficulties as well when you look on platforms to get real open interest for options is really difficult and very expensive, because a lot of it is done OTC. So for instance, there'll be a lot of the big banks out there will have effectively synthetic options in single stocks, in sectors, in bespoke indices, in regular indices. There's so much going on outside of what you see on the screen.
And the netting of those positions is super complex.
Exactly, the netting of those. So it's more, of course, on the IG platform, you got the tasty functionality that will show a reflection of open interest, but it can often be far in excess of what you've got, but it's still a reasonable
I think it's a good
reasonable
proxy,
guide.
right? And as that open interest number goes up, it is typically true.
Yeah, of course, it will move in step.
Yeah,
it will move in step, but it's generally the amplitude of that. That's why a lot of the volumes you'll see, especially next Friday, for instance, I like to tell people, and if you remember as well, single stock options expire at the close next week and indices at the open, so you're going to get potentially some pretty wild moves.
Those days are always kind of slightly crazy, where you have the different timings of
I've had some very interesting days doing that in some of my old jobs. There's some very long days. It was responsible for rebalance and expiry was responsible for me once working a 20-hour day, but that was like a long time ago. Systems were in their infancy, but all those old stories, all those old war stories of the market, no one cares about. But it was interesting. Yeah, look, Nike unchanged year to date.
But honestly, unchanged for a company that was on not a great run.
Behaving like an absolute dog, as
it's actually maybe okay, especially when you compare it to someone like
Well, if you've got Ange in the pair. So the pair trade you've got with Ange, is there any kind of settlement price at the end of the year? So it's like a nice lunch or something?
So if she wins, I have to buy her a gilet from Lululemon, and if I win, she's buying me a pair of Nike Air Maxes.
Wow.
So we'll see.
If the price cutting from Lulu keeps going on, that's going to be
that might be okay. When we started, I was like looking quite scarily at the price.
Yeah, that's going to be very asymmetric in your favour. I would guess. I don't want to jinx it. It's only September. A lot can happen between now and the end of the year. But yes, as some of the questions are coming through for Garth as well, because I know on a Friday he'll be coming out with some very interesting stuff. Back to Europe, actually, if we can just touch upon that. Let me just reduce my screen.
Doing the review of France's credit rating, which I think will be an interesting.
That's right. I mean, again, I guess most of the damage has been done for say sentiment purposes, I would imagine.
Yeah, the sentiment is pretty bad.
But again, I mean,
French yields were in and around the level of Italian yields. They haven't quite got worse, but like it's not far off. And I think the debt position is definitely getting a lot of scrutiny.
Yeah, I think this is a function of Europe, which frustrates people about the position that they're in, where they can just sort of arbitrarily say it's okay, it's fine, we'll back it with support mechanisms.
It's all just German backed, right? Really?
Well, yeah, exactly. Yeah, as long as Germany. But yeah, Europe is actually kind of circling the airport as regards a market, you know, for the stimulus they've had, and as Ange mentioned a little while ago about the defence show that she was at yesterday, and forward spending being brought in. I mean, if we just have, let me just bring up a quick look at the DAX futures just to show you a bit of an example. You know, they've not been doing a massive amount in the last while. They're in fact back to relative lows. Has that asset allocation, again, as we talked about, money flows, where that goes to?
Yeah.
Potentially, I just think that
they're just going to be going to the US, or
again, US potentially. Again, I think that
I think some emerging markets as well have been
some emerging markets. Again, not maybe necessarily China, perhaps, but things like Hong Kong, because you're seeing now some of the tech names in Hong Kong are really starting to get on the AI train.
Yeah, I mean, like Alibaba's had an amazing run, right?
Phenomenal, right?
Yeah, it's
absolutely
mad.
phenomenal. So yeah, you can see the relative difference in those charts there. And then,
yeah, wow, look at that. Is that the Hong Kong index?
That's the Hong Kong 50, which is a bit of a cheat.
Yeah.
Unfortunately, there's
still,
so many Hong Kong indices you could look at, and you have to explain which each one is. So yeah, Hong Kong 50 back to recent highs. I mean, if you contrast that with
look at that March though, it's so consistent.
Yeah, I know. If you I'm trying to get the Shanghai comp, but this is one thing that is not great on TradingView. So Shanghai comp as well, despite the overhang of debt, despite the lack of stimulus, that's just getting dragged up by that regional money. So that probably tells you, if we look at the Kospi as well, again, very tech heavy. Index. I mean, look at that. That's
so,
just,
wow. So I guess the question is, where is the money coming from? And it's probably coming from,
I would guess it's probably out of Europe right now. And again, look, if you've been able to move your money around fairly nimbly, you've had a great 6 months in Europe, which has been a massive underperformer.
Well, I think the word of the year probably is rotation, which is like we just keep seeing different
I mean, what a year for
trends.
that. It's been incredible. Again, I don't know how some of the really big global funds manage that rotation because of the nature of their flight to passive indices. And then probably just one more market to look at as well is the Nikkei. So all the concerns about debt,
FX,
and 30-year bond. Again, it's just, I mean, look at that. That's just crazy, kept going. In spite of the
do you mind putting up the yen, because I think that also tells us.
Yeah, we can certainly have a look at that very quickly, and then we'll probably make that our last thing to look at for the day. So the yen.
Dollar yen,
That's kind of been holding in okay, but again, that's been propped up with the weaker dollar, I guess.
Yeah, for sure. But you can see it almost like start to get tighter and tighter in.
Well, it's when, as you, I mean, as you absolutely say, if I had the time for drawing a couple of sloping lines, you'd see that wedge is getting quite tight.
So I wonder if there'll be a bit of a move.
A bit of a breaker, yeah. I mean, look, me personally, last thing to mention, I think once the Fed actually cuts next week, I can see the dollar rallying a bit because it's such a consensus short.
Well, I think they're going to cut 25 bips, and
that's right.
Anyone's pricing 50 is,
I mean,
a little bit crazy.
If they cut 50, I might have to go and hide in my spare room.
But the thing we'll get to see is the SEP. So if Stephen Moran gets in, then you'll be able to see where is his dot versus the other dots.
No, I completely agree. Right, so I'm being told that unless there's any last questions, any last points you feel compelled to bring up, that we're going to take a quick break, and then you're going to get a treat with Garth McKenzie on a Friday.
Nice.
Speaks to Ange about lots of different markets and his take on what's going on.
Let's do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns, that's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society of Technical Analysts with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Charting Crypto, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Watch Trade Live with IG weekdays from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show is finished, and Trade of the Week and Psychology of Markets.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Welcome to the Art of Investing, a brand new podcast to help you achieve your investing goals.
And I've seen at first hand the power of the wealth creation that one has been able to obtain from this industry. What we're going to do is we're going to put it into action by creating our own model portfolio.
We're going to be talking about the big indices that are around the world, because that is probably some of the safest ways for you to invest your money.
We need to bring this to everybody and help them then take control of their own investment story.
Join me, Rich McDonald, and my co-hosts Mark Spice Holden and Chris CJ Fellingham every Friday when we bring you updates from the markets and insights from our combined 100 years of investing experience. Welcome to the Art.
Hey, welcome to Expert Edge. And we are very, very lucky indeed to have Garth McKenzie, technical analyst at Trades Corners, with us, because Garth, you were meant to be in today, weren't you? And I was really worried that we wouldn't be able to get you in the end, but we thank goodness for dial-ins.
Well, absolutely, yes. I mean, I'm not in London. I'm in Guildford, a little bit outside of London, so I need to catch the train in and the tubes. And as everybody knows, this week is just an absolute disaster in terms of trains and tubes in London. So here I am in my office at home talking to you remotely. So thank goodness for Teams, and that's what we're on. And maybe next time, if they've sorted out the trains and buses and everything else, I'll be in studio with you.
Let me tell you why you shouldn't feel bad. So let's, if we can, Terence, whack up the pictures of the front of the office yesterday after I unplugged from home because I could not get an Uber for love nor money, and trains and buses up the creek. It looks like a Hitchcock movie, doesn't it, Garth?
Well, it does. I mean, you sent that picture to me on WhatsApp, and I had a good chuckle. You know, I forwarded that to a few friends of mine, and I said, how did people get around London before bicycles? And the answer, of course, is on trains. Lime bikes must have done a roaring trade in London this week, with everybody needing to get around. And as you can see there, I mean, people that I've spoken to just said actually they couldn't even find a Lime bike because they were so popular that all the bikes were used. It's unbelievable.
Yeah. Any of you working for Lime Bike, please tell them that they prevented Ange from getting into the office for the CEO of Pulsar Helium. I had to pick my way through, but I managed to do it. And we've got the Pulsar Helium CEO a bit later, so stay tuned for that because it's a fascinating company. Speaking of fascinating, let's start with the markets, because you know we've got almost like a hint of double trouble out there, Garth. We've got this, you know, 1-2 punch of slowing economic growth and rising prices as well. We've also got this, you know, real interesting move at the moment. Markets seem to be creeping higher in September, which is seasonally meant to be the worst month for stocks.
Yeah. Well, it is seasonally usually the worst month for stocks historically, but as I've said on the show before, these seasonal patterns are not a roadmap; they're history, and that these patterns don't always follow. And it seems this year so far it's not following. But what I must also just point out is that if you zoom in on the month of September and then break it down into its actual sort of segments of the month, it's usually the latter half of September that is actually a bit weaker. So we're kind of in the middle of the month now. So there still is the possibility that we could follow that seasonal pattern of a little bit of weakness in late September. And I do wonder if after next week's Federal Reserve rate cut, which is now almost 100% guaranteed, we're going to get a 25 basis point rate cut. Do we see the potential that there's a little bit of a buy the rumor, sell the fact type of scenario after that happens? And I've seen some of the big investment banks talking to that. I think it was JP Morgan earlier in the week who came out with a note saying, beware that you might find a little bit of a buy the rumor, sell the fact after the Fed cuts rates. I don't know. Let's see. But the point to come back to it is that from a seasonal perspective, it's actually usually the latter half of September
the last
that is
2
a bit
weeks.
weaker. So we've still got to see how that works out. We're on the 12th of September now. We're in the second half of the month from next week.
Garth, I'm going to be devil's advocate there. We had Julian Wheeler from Shard Capital on, one of our very loyal viewers and also our core guests here at Trade Live with IG. His view is we had that correction back in April. What are your thoughts on that?
Well, that's it. He may be right. We did have that big correction. That was obviously driven by tariffs and the concern around tariffs. But that was very quickly fixed up. And, well, as we know, the markets continue to roar up to new highs. And I think that, look, the pain trade is up at the moment. You can just see it. And those who are short this market are really, really suffering. And it's an unfortunate part of the nature of markets is they tend to push to the point of maximum pain. And maybe we haven't got there yet. And that maximum pain still needs to come out. So and with that being the case, and with this momentum just continuing and gradually grinding higher without really any volatility to speak of, because vols are really low.
It's like they don't care at all. It's almost like vols indicating that markets do not care.
Yeah, well, that's it. I mean, your VIX is it's Wall Street's fear gauge, and it's showing that there's no fear whatsoever. It's complacent, and there you see it. I mean, look at that VIX. It's sitting around, if you were to zoom out even further, I mean, we're sitting around 2-year lows on the VIX index, or close to 2-year lows. So there's a lot of complacency around it. The markets seem very, very comfortable. And I guess it's also it's a liquidity story. There's a lot of liquidity around, and liquidity is what drives prices ultimately at a very high level. And there is still lots of liquidity, and all of these asset markets are moving higher. And it's not just equities. We're seeing it in the bond market as well now. Bond prices moving higher in the US. Cryptos are coming alive again, starting to buzz. So you're getting across the board, actually, it's a pretty strong environment with everything going up at this point in time.
Yeah. Money looking for a home. We'll get to crypto in just a moment because we've got loads of questions there. Let's go through the dollar first. Let's talk about cable because, of course, we've got a lot of interest here, given now that we have that date for the budget as well. There's much consternation over why it was happening so late. But all the mood music I've heard surrounding cable is further downward pressure to come for sterling. What's your view on that? So are you looking at perhaps a punch through some key levels? I mean, we are getting quite close. I'm just going to mark this up so that our friends here can have a look. But we are now very close to that key level last seen in the middle of August, and that's the 136 level, and that was also last seen 24th of July as well. A lot of interest at this level from a technical perspective.
Absolutely. I like your chart that you put on there because that's 100% how I would have drawn that line as well. So that 136 level, as you can see, is a key zone of of resistance for sterling, for cable. So a punch above there would be bullish for sterling, actually, and it would probably send it up to 138, which was the previous high from earlier in the year. The question is, will any breakout there follow through, or would it be a false break? And we won't know that until after the fact. So with these sort of things, I always look at it and think, well, you've got to respect the break unless it fails. We haven't had that break yet, but it's looking increasingly like it wants to have a go at 136. And I mean, this pains me to say it a little bit, actually, because I've got some options on cable looking for it to move lower. I've got a put spread, a 135, 130 put spread on cable. So for me personally, I'd love to see it going lower. And for all the fundamental reasons that you alluded to, I think it could go lower. But at the same time, you've always got to look at the price action and say, well, what is the price doing? Because that's the only truth in the market at the time. And right now, this price does seem to be wanting to nudge a little bit higher. And to my point about market moving to the point of maximum pain, unfortunately, it looks like it's probably going to try and make a break through that 136 because that's where the pain trade would be. But it's also a dollar story, and the dollar's been very weak, and the US dollar index itself had been hugging the 50-day moving average for the last month or two. But it's recently just started to turn down below the 50-day moving average over the last couple of sessions and looks like it could be headed back to the prior lows. But, and I saw your previous interview on while I was waiting to come on air, and they were talking about the potential that dollar goes stronger after the Fed cuts rates next week. And again, in a sort of a relief type of move. There's a lot of short interest in the dollar. And the thing is, when it's very crowded like that, you can sometimes get these situations where you get a snapback in the opposite direction or a squeeze. So if you did get a US dollar short squeeze, then maybe then that 136 level on cable holds and it actually does turn lower. But I don't know. We'll see. In the fullness of time, we'll know. But to wrap it up, to sum this part of the conversation up, I guess 136 is a key level to be watching on cable right now. And there's a lot of interest around that level, as you can see on the chart that you've put up there.
Brilliant. Now, I know we've got loads of questions coming through on crypto, so we'll move swiftly to that. But first, I just want to double check with you, which camp are you in when you say, breakthrough? Are you one close above that level? Some people are, two closes above that level. Which camp are you in?
Well, I'm in the one close above. And the reason I say that is because often when you get a big level like that, it punches through very hard and you'll find a whole lot of stops get triggered. And so if you're waiting for two closes above, well, then you might find that by the time you want to put your trade on, it's already moved up to 137 or something. And by then it's a long way away from the breakout. And if you're going to put a trade on, then suddenly your risk to reward ratio is not great because you're now chasing the price higher. So for that reason, I tend to act when a break happens and then just know that if the break turns out to be false, well, then you have to have your risk management sharp and execute a stop loss if the break happens to fail. And that's the way I trade it. I just think if you wait too long to try and chase a break, often you end up missing the meat of the move anyway, which is not really what you want as a trader. You want to try and get in at with the best execution possible.
I like that, the meat of the move. Jugga asking, Garth, can you talk us through strategy and Bitcoin within the next up to 6 months, please?
Okay, well, look, I think if you can bring up a shorter term chart of Bitcoin, I'll just show you what I'm thinking in the short term. The break above $113,000 is bullish. Let me just see what you've got there. Okay, is this a daily chart? So if you just hover over 113,000 there with the lateral support line or resistance line, there we go. That's it. So there's actually a small little Yeah, there we go. That's about right, how you had it. There's a small little inverse head and shoulders pattern that's evident there that's been validated on the break above 113,000. So that in itself is short-term bullish, and it should open a move back up to test 120,000 again, which is around about the recent highs. We actually went a little bit above 120 last month, but call it 120,000 for there and thereabouts. I think that's the next near-term target. And then if we can break out beyond 120,000 on a more sustainable basis, that would then be bullish for new highs, probably to 135,000 is a bigger picture target that I've had for quite some time. So I'd have that as my view. And I think just in terms of going back to the short term, I mentioned this 113,000 level. Now that now should be a support zone. Because we've broken above that as minor resistance in the short term. And now you'd want to see the price holding above that level. And whilst price is above 113,000, to me, we're now, in the clear to move higher. And that's the area, to me, that's the critical level. We've got to hold that now. If we fail to hold 113,000, then obviously I'd have to reassess my thinking. But for the time being, we've made a break above 113. It looks good. We're above those moving averages again. And it looks to me like the path of least resistance now is to the upside for Bitcoin.
Gotcha. And just to be clear for our friends listening in or watching us on their commute, when you say fail to hold above that, do you mean one daily close below the 113,000 level?
Yeah, a convincing daily close back under 113,000 would worry me. And the thinking goes that when you have a break like this, if the break is valid, then you should find that there's naturally a flow of buyers chasing that break. Natural buyers, as well as short covering. And collectively, that should mean a wave of buying that takes the price higher. And it becomes self-perpetuating. If that doesn't happen, then you have to ask yourself why. Why would it fail? And the only reason it would fail would be because sellers are stronger than buyers. And in that case, you've got to say to yourself, all right, well, if that's the dynamic, the sellers are stronger, do I want to be long? Maybe not. That's the kind of thinking that I apply to it from a dynamic of understanding the flow between buyers and sellers in the market. And it's why false breaks are often quite meaningful, because when you get a false break, it means that everybody's on the wrong side of the trade, and it tends to move aggressively in the opposite direction to what the false break was.
Gavin Ackers chiming in whilst we are on Bitcoin. Gavin's wanting the monthly view on this, wanting us to look at the monthly view. Could you look at the bull flag consistency, Garth? Would you look at 140,000 as the next realistic move? This is the monthly chart here.
Yeah, he's right. And you can see a number of sort of flag type of patterns on that chart, and we're busy forming one at the moment. And they've all resolved to the upside. So I think that's probably fair. I mean, I said 135,000, but 140, it's there and thereabouts at the upside. And I would think that those targets, be it 135,000, be it 140,000, those sort of areas would be valid for a bull flag breakout of the current bull flag that we're busy forming at the moment. In terms of targets, and levels, it was not always easy to pinpoint an exact target. I think you can have your target in mind, but what you also probably need to do is have some sort of a methodology that keeps you in the trade up to the target, but also gets you out if the target fails to meet. And to that extent, I like to look at shorter term moving averages on the daily charts, for example, as a read to keep me on the right side of the momentum, but also to use those as a trailing stop loss in the event that a move maybe falls short of your target level. Or on the other hand, that maybe the price goes beyond your target and you're actually able to stay with the trade and run it further. Now, they always say you should cut your losers quickly, but run your winners, and give your winners room to breathe. It's easier said than done, but if you have some sort of methodology like a moving average that keeps you in the trade, as long as you're on the correct side of that moving average, it allows you to run a winner. In my experience, I've had often cases where you actually end up making more money by running a winner that just continues to run and run, utilizing some sort of a trailing stop methodology above a shorter term moving average. It's knowing when to sell is the hardest part of trading. That's in my experience, that's the hardest part. I find getting good entries I can do, executing stop losses I can do in my sleep, but knowing the right time to sell is the hardest thing to get right in trading.
And also, never looking back. I find, if you take profit and you look back and you kind of go, oh, I should have stayed a bit longer. Hindsight's a wonderful thing, right? Hindsight's a wonderful thing. You can't call a top. Anyone that can tell you that they can call a top, well, they're fibbing. Speaking of which, I'm showing you the. I love this job. This is why I love it, because I thought when I left school I wouldn't be able to, merge my drawing skills anymore. But actually, I have been doing a bit of drawing whilst we've been talking to illustrate the bull flag that was helpfully mentioned by Gavin. So Gavin Ackers, thank you for testing my flag drawing skills there. But there you go, just to illustrate what Gavin, hopefully that is what you were talking about, Gavin. Please let me know if I've got it terribly wrong. More questions coming through. We've also got someone asking you to look at strategy, as it's called now, and also Ethereum.
Yeah, well, let's talk about Ethereum first. I'm long Ethereum after it's held a lovely lateral support area at $4,300. It's been testing that over the last month and a bit and held perfectly. And now we are starting to break out above $4,500 for Ethereum this morning, which is also bullish. I think you've got a longer term chart there. If we go into something more short term, like a daily chart.
There we are.
Yeah, there we go. So there we are. That's your daily chart. So you can see all those lows over the last couple of weeks come in at around about 4,300, and we've been holding that very nicely. And now we look to be picking up off that level and starting to turn higher. So and the fact that it's gone above 4,500 this morning is actually quite encouraging, because that takes it to a new high for the month to date. And to me, it looks like it's heading back up to about 4,800, possibly 5,000 as the next shorter term target, basically to go and revisit the previous highs. So I am long Ethereum at the moment for that reason, and quite happily long, and actually looking to add to that position now that it's showing to me that it's working out. I've been waiting for a break above 4,500 to add to the trade, and it's doing that this morning. So, they say add to your winners, cut your losers. I'll be adding. I have added a little bit this morning. I'll probably add a little bit more if it continues to show that it can sustainably hold above 4,500. And bigger picture, this looks good. In fact, now I've been saying to a lot of my clients that the cryptos that have actually been showing the better relative strength in the near term have actually been Ethereum and Solana. And those are the main ones that I follow. I mean, I know there are plenty of others out there, but I don't follow. But in terms of the big ones, it's Bitcoin, Ethereum, and Solana are the ones that I mainly follow. And Ethereum and Solana actually have been, on a relative basis, they've actually been stronger than Bitcoin. So if that theme continues, then you might actually find that those two continue to outperform.
I have a theory that I'd like you to poke holes at. So I have positions in Bitcoin, Ethereum, Solana, and XRP, and I've been dollar averaging into Ethereum and Solana, and it's just on the basis that their charts are looking positive. In my humble opinion, this is not in any way advice to anyone, but also my theory is that, with the Fed going to cut, or that's what's indicated or suggested by markets, that liquidity is going to have to find a home.
Yeah, I think that's right. And I think that's what we're seeing. And it's what I alluded to earlier, that liquidity is very strong moment, and as a result you're finding that money is flowing into all of these asset classes, and it seems to be bullish all over the place. equities, cryptos, treasuries, all of these things are catching a bid. There's a lot of money looking to find a home. And whilst that's the case, I think the likes of these cryptos that you've mentioned, should be beneficiaries of that.
Right.
Yeah.
Thank you so much. I'm going to have to leave it there because we're coming right up to all sessions. We got tons of questions, which I'm going to put to Garth after the show. I see you, Jugger. I see you, Monkey Man, and everyone else. Do also slam the like and subscribe button if you really enjoyed this chat with, with all of us, because that's how we get all the splendid new stuff in the studio, and that's how we can also get Garth back on again with us. So good to have you, Garth. We have to get to all sessions now. We'll speak to you soon.
Thank you very much, Ange. Good to see you. Cheers.
Here we are, and we are off to races. Scotty is back with us. He's like a magician. He's like a ninja.
Just dropped the cloth and it appeared.
It's amazing stuff. So let's get us across the winners, because it's looking like cautiously higher at the moment. Let's have a look. Supermicro is top of the list at 4.5% higher there.
Yeah, so Adobe's up 3.4 after numbers. They were up a couple in the aftermarket. Nothing too exciting. That's a bit of a forgotten platform, really. I don't know what they can do to actually get people back interested. But again, that's decent. Again, as you were talking to Garth there, look, a lot of the crypto related or the higher beta names having the earlier move. Just having a little look a bit further down. A stock I did see mentioned actually on the overnight. So at the beginning of the week we were looking at Novo Nordisk quite a bit. So then I think if we can look at the relative performance of those. So we'll look at Novo's first. Had a bit of a jump up where unfortunately make the announcement that it's letting go 9,000 employees, which is unfortunately what happens when you're in a hyper growth phase. But contrast that with the chart of Eli Lilly, and that's actually been very quietly making a pretty good recovery. And you'll know how important a gap close is when we look at Eli Lilly.
Let's have a look at Eli, because I have a position in Eli in Ange's pension fund. Here we are.
So you can see it's had a lovely close of that big sell-off lower. And it's right on that. It's right on that level there. That from the August sell-off on the numbers that we can see the big red block down. So yeah, that's getting quite interesting, and just goes to show even in companies where they look to be in the same predicament, that you can have the differing fortunes, especially where it's all about these weight loss drugs and so on. So I thought that was quite interesting. So yeah, a shout out to CNBC for mentioning that this morning. To be fair, I did have to steal it from there, but I think that's quite interesting. And like Garth was saying, if these things get back above, let's say 80 on the scale there on the right hand side, then all of a sudden that's getting quite interesting again. So yeah, that's certainly one to perhaps keep an eye on in that space. If you like looking at pharma names, I know they're always difficult to trade because of the headline risk around products, but I thought that was quite an interesting little flag outside of the things we've been talking about.
Yeah, but that's also why we look at charts, right? Because charts, we always say this, because it is just a canvas on market behavior, and we always get told over and over again that these aren't just dots or lines or candles. These are actually people in the market, and the reason why we look at whole numbers as well is because that tends to be what people remember, and that's then trickles down to how they program their algos, right? And whole numbers, when things, we talk about inverse polarity a lot here as well, because there are a lot of measurements that go on for the algos to try and predict realistically how far or something might fall or rise. Speaking of which,
a lot of those predictions, though, as you know, are based off historical price patterns.
Exactly. And so that feeds into the markets have a memory. So speaking of memory, do you ever shop with using Ocado?
I do. you always know when the Ocado van is outside because our Labrador goes absolutely bananas because he knows there's normally something in there for him. So yeah, he lives a very privileged life. There's our family pet. So yeah, I always know he's there. Yeah, look, I still like the service. It's just unfortunately one of those ones where, because of margins and the cost of running the business, that they just have these phases of underperformance and outperformance. It's a stock that suddenly you can turn around and it's had a big move in both directions.
Yep. And that we see that today. So it's down more than 9% there, down more than 9.5% now as we speak. And that move coming very much so early this session. It's starting, those of you, if you did short this, well done you, but just be aware it is starting to turn.
Is there some sort of update out?
So this is why I'm bringing it up. If any of you know why Ocado is moving like this, I would like to hear it because I've been watching this since 8 o'clock, just in the corner of my eye. There is nothing at the moment that I can see that is behind this move. I mean, Ocado has, let's just show you the daily chart. You know, it has had a sizable climb from July to around middle of August. But it looks as if it is making its way down to the levels last seen in July again. I'm going to try and draw that for you so you can see that a bit clearer. Anyone knows what's behind this move, please let me know, because there's nothing on the wires or on the greater internet.
I can't believe Angie's radar, that all-seeing eye.
Yeah, omniscient. But my filters that I've built are not moving. I do not know why.
That must be almost the first. I can't
Maybe you haven't been shopping enough for your dog treats. That's
Perhaps not. If it was Friday the 13th today, I could attribute it to Angie's radar not quite functioning, but no, that's not even the case.
I tell you what else Angie's radar is picking up is Adobe. So we're just checking out Adobe again because you know, this is one that you know, we haven't yet covered, but the company did up its annual revenue and profit forecast. Remember, it's a bit like dating. It's not what the stock delivers for you now, it's what the stock delivers for you tomorrow, people. And it is up 3.4% and actually even more now, 3.7%, because of that optimistic outlook. We talked about Warner Brothers earlier on.
Oh yes,
that is moving, people. Trader friends, that is moving. Let's have a look.
Forget that.
Right, here we are. Take a look. That is the chart, but this is the let's see. Warner Brothers is not one that is offered on all sessions, so keep a lookout at the cash open, because my filters that does catch the pre-market is indicating 4.3% higher after jumping more than 28% in the last session. So if you're looking for one to catch at the cash open, this could be the one. Let's cross it over to see what's happening with the losers on the all sessions. So just having a look at this, and if you have built your own list, here's a handy hack. You can change a percentage. You learnt about this, didn't you, Scotty?
I did.
And you said, Ange, why did it take you so many hours? Because I had to do this from scratch. And that is the only way at the moment. I've lobbied for this change, but that's the only way you can kind of filter it. Don't add it to the workspace because then your filter button disappears. But if you zoom in, you can.
Understood.
Yeah, you can filter it. There we are.
Tip of the day.
Tip
of the day.
Right, take us through the losers list.
So JD, that's just a little bit of a pause after a lot of the tech firms in Asia have had a very big run, particularly as we mentioned with Esar, Alibaba, but yeah, a lot of the China tech names have been pushing indices to those highs. Best Buy, another one for the retail space. The retail space has been quite mixed actually, with some of the winners like Walmart, which have been hurt less from the tariffs. But again, that's just a pretty small move. Again, Chevron, very similar to the oils move that we saw across Europe and the UK this morning, just a little bit softer. eBay, Broadcom again on the, on the basis of the moves it's had this week. I think 40 bips lower is probably not even raising the eyebrows for anybody.
No.
But yeah, that's generally, I mean, just kind of scanning down there, look, you can see Walmart weaker, all names weaker. You can see the picture there across the sectors.
Let's have a quick look at the winners just before, because Bill is waiting in the wings.
Is it Bill time already?
Yeah, Bill
Oh, my
Blaine.
goodness.
Supermicro Computer is up 4.4%. We already covered Adobe, which is up as well. Tilray up 3.7%. Seems to be a good week for Tilray.
Amazing.
They're, if I remember correctly, related to cannabis, aren't they?
I will have to defer on that. Yeah, so just very quickly to finish with, as we were talking this morning, Ange, a bit of history, new history buffs now. A lot of people in London like to talk about the origins of the stock market. Jonathan's Coffee Shop in Sweetings Lane, which is actually very near to where we went for coffee last Friday, is reportedly the first exchange that opened in 1698. But I noticed this walking past the Guildhall this morning.
Interesting.
The Corporation of London.
Interesting, because like you, I also, learned the whole
Most people
coffee shop.
anecdotally.
Yeah.
I think the first index was supposedly in Holland for all the trading that the Dutch East India Company used to do. But yeah, 1282 to 1737 was a stocks market happening there. I'm sure if Rich was here, he'd most probably say I was there as a new joiner.
Yeah.
When that opened. But yeah, I thought that's a nice little way to finish.
He's aged very well, hasn't he, our Rich? He's aged very well.
He's aged incredibly well.
Guildhall also, interestingly enough, where I graduated. Let's have a look quickly. We've also got MicroStrategy up 1% there. Novo Nordisk, after really being pummeled, up percent there. And some of the crypto-related names, Mara Holdings up 1% there.
Yeah, actually, Monkey Man, very quickly, a last one, because I know this is one close to our hearts, just asking how Apple's doing. So for me, quite interesting. It's closed a big gap lower. For me, there, just you see on the right-hand side after the new product day, it's closed that gap. Apple does like to close gaps because it's one of the slower moving of the tech names. So it's indicated kind of neither here nor there. I think this is going to be one of those ones where the proof in the pudding is going to be in the eating. You've had the good news of the Google AI, Siri tie-up and so on. But again, the market for a product that is so sort of omnipresent in everyone's lives, you generally have to wait for sales data, new product take-ups. But I do like the fact it's closed that gap really quickly and then stopped, and it's trying to reverse. So for me, looking at that, I think that range it's in, that new zone it's in of the 225 up to 240, that looks like that should be the new range. And most probably, perhaps that's one for next week after some of the excitement subsides out of some of the other Mag 7s.
Yeah. Meanwhile, the hills are alive with the sound of money.
The bills are alive.
They're alive. Checking out Tesla before we go, because Tesla is up another 0.5%. There, friends. There we go. Off we go, revving higher. So it does show that Musk should learn how to keep quiet, maybe.
That's right.
Yeah, but on that note, we're going to have to love you and leave you, but don't go away, Scotty, because we are going to have a quick drink after this. But first, we've got to get Bill Blaine on the show.
Excellent.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial instruments, like shares, indices, forex, and commodities, without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think the market's going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission-free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
do this. Hello, Pat Cash. So guys, I've always been known to be the fastest, fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Oh, yeah. Hey guys, where are you going? You're not going to get better than cash returns.
Hey, welcome to Expert Edge with myself and Bill Blaine from Windshift Capital Advisors. How are you, Blaney?
I am tickety-boo, and, well, what a week it's been.
If you're talking about the excitement earlier on in the week when a bunch of us were kind of going Article 4, Article 5, that kind of excitement or personal excitement?
It's been a mix of stuff. I mean, it's been a really topsy-turvy week. I mean, it just feels there's so much distraction and noise going on, whether it's been the bombing of Qatar or the assassination of Charlie Kirk in the States. I mean, I happened to comment on that in a very mild form, saying I was concerned about the polarization that it's generated in the States. I put in a quote from Alistair Campbell about, unwise tweeting by some US commentators. And I have been deluged in trolling from American
You've been
leaders.
trolled?
Must be. Yeah, it's about 2 o'clock in the morning in the States. And
Oh,
I'm getting,
goodness.
what kind of lefty are you? I mean, all I'm saying is, my comment in the morning porridge this morning was all about what would a Farage government mean for the UK, but somehow that's upset the Americans. But it has been a fascinating week. And I know you were at the defense show this week.
I
now,
was.
that is something we should chat about, because
It changed my view. It changed my theory.
the world changed in terms of defense. I think it's pretty clear that Qatar bombings, Russian drone incursions into Europe, and Trump basically blubbering on it and doing very little means that the impetus for European defense stocks, to my mind, has got to be increasing.
But here's the thing, Bill, and if you missed it, I was on earlier on the show. I mean, speaking to so many people that I'm heading back there after today, by the way, because it's a 4-day show for those of you that are unaware of this. Happens only once every 2 years, so it's a great place to kind of gather the new music. I'm really underlining, I am not for war whatsoever. It is just something that is since time immemorial, humans have been scrapping, right? Let's face it.
Oh, yeah.
Let's be honest. Humans have been scrapping since we could throw rocks and before that. And so it's also a great place to understand the dynamics between different countries, where investment flows are heading. One of the key things that I got from speaking to many people there, Bill, and also just watching which delegation is bigger this year, is that you're right. No one seems to be talking about the incursions earlier this week. No one seems to be talking about, what this means for NATO, which suggests to me that this is a paradigm shift, right? But also, if you're interested in, I know that you went in on European stocks after the Trump results and the election as well, election results were in. The whole mood music about, the spend already in place. So there's no more extra cash. There's no more extra cash right this moment to flow into European defense. To me, suggests that that's flowing elsewhere. And so I'm looking at, other regions, and I gather that you have something up your sleeve as well. You're developing some new fund. Tell us more.
No, I made the mistake.
I'm hearing
of pouring
on
my
the grape.
heart
It's a very
out to
small
journalist,
industry.
and
It's a very
she's
small
just
industry.
spilled the beans. Oh, that's the last time I tell you about what I'm up to in my day job, Angeline. No, I mean, I take your point on board. I think you've got a very, very strong point that we have known that European defense was going to be a topic since the moment Trump won the election. Smart money piled in to European defense stocks. You just need to take a look at Rheinmetall, BAE, Leonardo, and some of the other names. And I absolutely get it that now we are all invested in Europe having to defend itself. So, yeah, what is the ongoing upside? Well, I thought your opening comment was very, very interesting. We're against war. Now, we've known since the days of Athenian democracy that the way to avoid war is to be ready to fight war. Be prepared, Boy Scout time. And that's where I believe the future of defence remains very pertinent to Europe, and why we will continue to see increasing defence to make Europe absolutely secure and to create a European defence structure that is going to replace the Americans, because I think we have to be absolutely brutally honest and prepare for the very strong likelihood that American troops are about to be withdrawn from the Baltics. So we need to have weapons in place. And that means constantly coming up with new things. Now, I'm thinking back to some of the great periods in British history. I'm thinking about in the aftermath of the First World War, we thought that there was a massive peace dividend. Armies were descaled, investment into navies and the new Air Force concept dwindled immediately. And we saw money trying to be saved as much as possible. And it was only private money coming in that it was only private money coming in to support defense infrastructure and defense innovation spending that really kept things going. And there's a great story about a rather eccentric British lady called Lucy Houston. She had had a succession of very rich husbands, and she was fascinated. She was a true patriot. And she saw that the RAF was going to have to pull out of something called the Schneider Trophy. And this was to build the fastest seaplane. And the actual races of these seaplanes took place just where I live, on the Solent, down opposite Southampton in the UK. And she actually funded the RAF to build the Supermarine SR6, which won this trophy 3 times in a row, and therefore Britain retained the Schneider Trophy. Now, that plane, funded with private money, went on to become the Spitfire.
Wow.
The weapon that effectively won Britain the Battle of Britain. Well, that's what they say. It was actually the Hurricane, but the Spitfire is a damn fine looking plane, and whenever you see one pass, and whenever you hear one, it's incredible. Everyone's eyes go, wow.
I just saw one 3 weeks ago, actually, on my Perception kayak in the middle of the sea. So I was, it was the first time I watched it from the sea. It was incredible.
Yeah, so that's just a hint of something. And I'll tell you what, since I made the mistake of telling you something secret, one of the projects I'm working on, when we launch this new fund, which will be a hybrid fund looking at defense stocks, with the aim of making sure that Europe is safe and secure, then I'll come back and give you a full briefing on it. But in the meantime, I remain very much in long European defense stocks, because I see that as the best way of ensuring we don't have a war in Europe. And you got to look at this, where we are in terms of geopolitics. One of the big things we've seen emerge this week is it's pretty clear that all Donald Trump's efforts to win a Nobel Prize by overnight peace in Ukraine and immediately solving Gaza are absolutely going nowhere. The Israelis have taken him for a ride. Russia has taken him for a ride. In Europe, we're the ones that are going to have to fund Ukraine, and that's fine. Ukraine is our responsibility, but it's also part of our business to make sure that we go with it.
So here's the thing, Bill. So even if Ukraine does achieve some sort of, treaty with Russia, they're still going to have to arm themselves. But the reason why my theory has changed slightly, I'm going to show you. You talked about Rheinmetall. Many of you on the show here heard me say that after the big leg up, I was taking money off the table because around sort of February, April time, it started getting quiet as to what was happening with European defense, and I was starting to think maybe a lot of the gains had already been baked in. You can see a bit of consolidation there from June as well. And some of you also then said, what are you then looking to dollar average into, just as I wait for more information. And I said, when in doubt, stay big. When in doubt, stay big. So BAE Systems is a titan in the European space. It also has its fingers in every pie. It had by far, always every 2 years, the biggest stand, but the stand this year was on steroids. It was a double story stand. And we have seen this breakout as well. This is the daily chart there. And I've put that area of interest there. So BAE Systems, as you can see here, not suffering the same sort of summer lull that some of the Rheinmetalls did. Staying big, Northrop Grumman, that's another one. So this is on the US side, and as you can see, it also did not suffer much of that summer lull and has picked up. Pelican on the show asking whether I saw drones. Not only did I see drones yesterday, Pelican, I also looked at
I'll bet you did.
I did indeed. I'm going to see more today. There was one on the kinetic stand, and I said, what? Is this made out of polystyrene? And the answer is yes, because they're finding that polystyrene is able to evade some of the anti-drone type missiles, because it's, some of these missiles are programmed to seek heat or metals. But polystyrene, well, that's easy to make, right? But also, it's hard for anything magnetic to stick onto it or to actually find it. So that was really interesting. The other thing too that was interesting was on the drone front, Bill, tell me if I'm boring you to death, is that the tech for drones, it's moving so quickly. It's moving so quickly that the MOD and all the other defense government bodies out there, having to think twice, because look, you're going to invest in something and then in 2-3 years time, it's going to be out of date, because Kinetic, which makes Dragon's Breath. Have you heard about Dragon's Breath? So this is an anti-drone, and I'm going to try and bring this up for you, Dragon's Breath, and it looks incredible.
Systems that can defend against drones are part of it. The other thing you've got to look at in drones, not just drones themselves, but drone logistics systems, drone management systems, anything that makes drone offensives and defense even more effective. These are all the things that we're learning from the Ukraine war. And you know what? The Ukrainians have done a superb job of inventing and innovating quickly in that area. That's why they're leading this game. But now we're beginning to see some really interesting new ways of using drones and using logistics to keep them supplied, to mission them, to make them work. It's brilliant. And if you can develop something that protects against drones, then suddenly you make tanks effective on the battlefield again. So the Israelis are at the forefront of that. Yeah. It's a fascinating business, but there are other things going on this week as well.
There are. Just very quickly, just going to wrap this up. So that is the thing I was telling you about. It's called Dragonfire laser, and it can take out something that is the size of I believe they said a pound coin a kilometer away. Just by targeting this laser at it. The deployment expected 2027, but it's already there on display, and it's not a prototype. It apparently they say that it works very well. So I managed to see one of them at the show. Right, loads of other things happening,
Fantastic.
Bill. Wanted to ask you as well. You know, your morning porridge. I had to like kind of take a swig of coffee when I read it because you have some strong thoughts, both sides of the pond. Which side do you want to start with? The US side or the UK side?
Well, I think we should let us not risk talking about America, lest the pair of us get accused of heinous crimes for saying something obvious and being accused of being left or rightish for doing so. The key themes that emerged for me this week are gold contingent, and the uncertainty created by events in Ukraine, in Poland, in Qatar, just confirms to me that we have ongoing stability and uncertainty. There is no sign of that being quickly resolved because the peace initiatives are going nowhere, so therefore gold remains top. The second big issue that I'm thinking about this week was that extraordinary rally in Oracle. Now, 2 weeks ago, you did a brilliant job ambushing me. You asked me a question about Oracle, and I was completely like, okay, well, I know they're trying to break into AI, but yeah, I'm sure they'll do very well, but they're a very old company, and they're trying to align their product to fuel drive data centers. Wow, yeah, 43% up in a single session on the back of a massive contract. And then we step back and say, let's take a look at that contract that they've done with Sam Altman at OpenAI and the name that really matters, Masayoshi Son of SoftBank. And I came away from my thinking about that with my brain screaming, we work. Here's a company, OpenAI, that doesn't expect to be profitable till close to the end of this decade. And it's going to be paying somewhere in the region of, I think it comes out 60 billion per annum to Oracle for its data center services. That means it's going to have to borrow enormous amounts of money. That means Oracle, which is already very highly leveraged, something like 400% of its annual profit. That just tells me that is a deal that is priced for current perfection. If there was a rise in interest rates, or if we saw any kind of recession, or if we saw the AI bubble to burst, heaven forbid, this is not going to make any kind of sense whatsoever. And that got me thinking about the whole of the AI market, which brings me to Blaine's library. Blaine's library. And one of my summer purchases, which way do I need to put it the other? You see, this is what happens.
The AI
Con, it's called.
Who is it by? I'll bring it up.
Oh, it's by Emily M. Bender and Alex Hanna. The AI Con, How to Fight Big Tech's Hype and Create Future We Want. Now, it's just one of a whole series of things I've been reading about AI, but it came out with a brilliant quote buried in the thing, and that is, like all great tech barons, Sam Altman is just an ad man. And that really set me thinking, what is AI? Let's be brutally honest. AI is not intelligence. It is artificial, but it's not intelligence. It's just number crunching on the grand scale. And that has been enabled by the constant evolution of computer power. And that got me thinking. Over the last 2 years since the launch of ChatGPT, we have seen an extraordinary investment, an investment race to see who can plow the most money into AI, who can build the chips. It's fueled the 700% gains in NVIDIA. It's fueled all the expectations of enormous wealth through all the big tech firms. The top 10 tech firms have about doubled in value as a result of what we expect AI to do. But what if it is just hype? And that is what investment desks around the world are now beginning to consider. Where are the actual improvements that are promised? All we've actually seen are loads of people losing their jobs and being replaced by robotic AI-driven chat centers that are 100 times worse and are causing these companies to lose business, and they're desperately trying to rehire people. So that's my second big theme of the week. My third big theme has been the absolute shock and horror that we've seen in the US. Now, it is a tragedy when anyone is killed. And this was clearly an assassination of Charlie Kirk. We have no idea who it was. Personally, I doubt that President Trump is right by blaming the radical left. My own experience of meeting left-wing progressives is they cannot even order a cup of coffee without endless debate about the wokery of the coffee. And for them to organise a political assassination, I reckon, is so far beyond them, it's laughable. But the fact is, the USA is left even more polarised and divided. And heaven forbid that you comment on this, as I made the mistake of doing this morning, in a very simple line in my morning porridge where I quoted Alistair
you know
Campbell.
better than that.
Yes, I do, but I made the mistake because I didn't think that they were that touchy. They are. Yesterday, chatting to American friends, I just staggered at how significant this assassination of somebody those of us in Britain know probably very little about. And I think that just all adds to the instability and the uncertainty that we are seeing about investment into the USA. And it's that kind of investment that the Republicans are relying on to keep the economy functional. So that kind of all came together with my own thinking about what's going on in the UK. Now, I don't think it's any exaggeration to say that the Labour government is not exactly demonstrating unmatched political competency at the moment. I do think
at least
they're
they're hiding it very well if they are.
Yeah, they are hiding it very well. Now, the thing is, they lack party discipline, and no matter how well-intentioned Keir Starmer is, he's a lawyer. He's not a leader. There is no discipline. Where they do manage to get policy in place, it's immediately being blitzkrieged, and they don't own the media. They are not controlling the media. Whereas in contrast, Nigel Farage has got a very strong control over the media. All he has to do is say something outrageous about immigration, and the cameras immediately refocus on him. So we're all aware that Farage and Reform are currently leading the polls, I think 35% to Labour's 20%, which may even then be exaggerated because of Jeremy Corbyn's potential split. And it's pretty clear that at the moment, ceteris paribus, we are heading towards Reform becoming the next UK government, probably in 2029. So what I tried to do this morning in the UK, in the morning porridge, is say, what are the questions that Farage needs to answer, and what does he need to put in place in terms of a strong, well-disciplined party that will be able to address all the multiple problems that the UK faces. Now, my conclusion will surprise people and says, in that it is possible.
Go on then. I like being surprised.
If
it is
he
possible.
Can get
you
the
think?
right people in place, if they can come up with competent policies, and remember, the market will start pricing this into the price of UK assets, including the critical gilts market, as we approach that election. And it's all going to be in the lap of Nigel Farage to make sure that he demonstrates competency and good politics.
And
that's
that
a
is
big
the
risk
key
for the UK.
thing. That is the key thing that you just said. Demonstrates competency. That there are many in the know, and many that have been reported in the media as well, that wonder if Farage is that sort of person that likes being on the attack. But actually, it's a very different thing, isn't it, Bill, when you're actually doing the job? We all know that. It's very easy to criticize and to say this isn't going right. What do they know? They're not doing a good job. But it's another thing when the chicken comes home to roost and you have to make the tough decisions.
Yeah, it's easy to criticize. It's very difficult to do. So that's in the morning porridge, www.morningporridge.com this morning. And I'd be really interested to know what your viewers think about it. I've tried to be dispassionate about the whole thing. And, you know, to an extent that I seldom do, I have been. So I'd be very intrigued. Aside from that, though, I think my main focus at the moment is trying not to read the Twitter sphere for what's coming out of the States. It truly is scary, and that's why I sound maybe a little bit depressed this morning.
Oh, we don't want to depress Blaney. Let's take a look at, the markets, because, we are still seeing a lot of caution, but not as much as I expected. We're still seeing, the relative grind up still in place there. More green bars than red bars. This is the S&P 500. We had Garth McKenzie on earlier talking about how, wait a minute, we haven't got to the last 2 weeks of September just yet. And the slight hint of a stagflation, I can't speak anymore because it's been a week of no Rich, no Phil, and have to say, this is a good point.
You're talked out. What we're about to say, Andrew, is that we've got
stagflation.
The US numbers suggest that we've got declining labour market, and even though the inflation numbers this week were really weak,
there you go,
they still may be disguising the real effects of tariffs hitting it. Well, next week we're going to get that Fed ease. That will take some of the pressure off US consumers. But
where
it is
are you on?
not
You're 25
yet
or
clear.
50, Bill? 25 or 50?
Oh, I have a suspicion it's going to be 25, but I know that Trump this morning is pushing the U.S. appeals court to let him sack Governor Cook so that he can get his 50 basis point cut. But let's see what happens. I mean, there are so many things up in the air about the U.S. economy just now in terms of we don't really know where the numbers are going. This week's inflation numbers, as I said, were weaker. And you can run all kinds of narratives around it. But when you've got the stock market as strong as it is, when you're seeing earnings as high as they are, when you are still seeing this inflationary impetus unknown, in any normal world, no central bank would be considering easing. They'd be saying, let's just hang on and see what happens. We do not want to make this worse. And stagflation has gone from a very high threat at the start of the year to no threat in April, and it's suddenly back on the threat board again. And, let's see where we go. Is it next week? Yes, it's next week.
It is next week. And also, I was thinking about this a couple of weeks ago when I turned into a bear live on air here. Can you believe that?
Oh, that I'd like to see.
You're normally the bear. You're normally the bear.
Good,
I was thinking,
I'm never bearish.
Inflationary
I've got a big swinging
times
pair of horns.
of 2022, we've seen that, in the US as well. The rising prices there. Some Americans say it was like the biggest rises they've ever seen, that they've ever remembered, right? But that coincided with a booming labor market there. People still had jobs that underpin that inflation. It's okay, we're still bringing income in and that kind of thing. But right now we're seeing, cracks in the US labor market there. No one's talking about those stimulus checks anymore. Remember when we were talking about stimulus checks all the time post-COVID? All that's gone from the system. And we still have this rising inflation situation, real feel on the ground. And now unemployment is ticking higher. So my thing is that
it's not really ticking higher. What's happening is the pace of employment is slowing. And the rate of inflation is slowing. But these two things could be due to all kinds of factors. The employment numbers, there may be a large element of the deportations that is reflected in that. At the end of the day, the US economy is still very much functioning.
It is functioning.
A friend of
I
mine
agree.
was telling me he couldn't get a hotel in New York last week. So there are, rumors of his deaths are exaggerated.
My whole point, I completely agree, and I was going to get to that. My whole point is we're getting to a point where it's not going to take much to break the U.S. economy. All things, it's like a swan, right? It's like a swan has been doing that swan thing for a long time.
No, I'm going to do. If you're going to do that, I'm going to do that. Right? Okay. I'm going to turn that around and say the U.S.
You got to make it quick because we got to wrap. Quick.
The US economy is fundamentally small because it is big and internalized. Compare that to the UK. We are a small, very, very crowded island We need to trade with people. Our economy is very fragile. And that is the main difference between the two economies. And that's why we probably need to make a decision about going back to Europe, because we can't rely on America anymore.
yeah.
And on that bombshell.
And on that note, I think Bill's off. We're going to quickly, get to the Pulsar Helium CEO interview, because guess what? We've got some, questions at the end from Maturin, which I put to him, and also from Monkey Man. Thank you for sending that across. But Pulsar Helium, really interesting space. We seldom get to look at other commodities. Well, this is one that is very interesting. Stay tuned. Welcome to the show. We have a special treat for you because we cover all financial assets, commodities, but rarely do we get to talk about helium. And today, joining me to do just that is the CEO of Pulsar Helium, Thomas Abraham. James.
Very happy to be here.
So this is fascinating to have you, and such a pleasure, because rarely do we get someone from the helium space. How did you get into this field?
It wasn't by design, I can tell you that much. So I guess you could say it was somewhat fortuitous. It all began about 12 years ago now, and my background, I'm a geologist, and so I had a wonderful job actually, exploration geology, and I was working for a private company at that time over in Africa, and my job was find something of economic value. So I had complete free rein to make a discovery, and whilst over there, then came across helium. And it was tucked away, squirreled away in this book that I was reading, and with a colleague of mine. And then we found that Tanzania had this helium accumulation. So I went back to my employer and I said, well, mission accomplished. I found what you were looking for, a potentially economic deposit of helium. At which point they started laughing at me and said, happy gas. And that's, and that, look, they weren't really looking to get into the clown industry and so on, but thanks very much. And that was the answer I was actually quite hoping for, because then I could go off on my own and start to create my own helium company. And so then ultimately left and ended up here with Pulsar.
Now, Pulsar describes itself as a dedicated primary helium company. Mm-hmm. How does this set you apart from, rivals who treat helium as a byproduct?
Yeah, this is really the key differentiator, so the word primary. So at the moment, the helium industry, for the end user, so we're talking about big companies here, NVIDIA, Panasonic, SpaceX, the supply chain to them is quite, I use the word ugly, to be honest, because it's a byproduct. And so they then have these long-term take-or-pay contracts. And so every week they get their delivery of helium, should they need it or not. And so it does account for a lot of waste of helium, inflexibility for pricing, and then if one of those natural gas plants goes down, then there's no helium. So for us, it's all about helium being the primary economic driver, and with that, being able to offer some flexibility to the customer. You want helium now, you don't want helium now, to be able to be dynamic with supply for the first time.
Now, for those watching as well, thinking this sounds really interesting, right? Where else is helium used? Because most people just think helium balloons.
Yes.
Right? So take us through some of the industries, because this is such a fascinating topic. Space as well, and a lot of technology relies on helium.
Yes, it's I'd say, well, firstly, party balloons. That makes up about 4% of market share and is a frivolous waste of a very valuable commodity. So, but everything else is high tech. So the best way to think about helium is due to its unique properties. So what you want to keep really cold without it becoming a solid. So helium is a liquid at negative 269 degrees Celsius that is completely inert, so non-flammable, it doesn't react, it doesn't rust, oxidize, and so on. And that's helium. So when you think about these high-tech applications, so cryogenics, effectively, what do you want to keep cold? So space launch, when you're using the fuel in a tank, you put helium in there to maintain pressure. For making semiconductors, you need helium. For MRI scanners, for the magnet to superconduct, you need helium. Cooling data centers now they're talking about as well. So all these new applications of requiring cryogenics, that's helium.
You just announced a 10-well drilling program as well, starting quite soon at Topaz. What sort of milestones should investors, if they take a position in your company, watch for between now and first production?
Pretty exciting time. So we've really ticked the boxes for, is the helium there at Topaz over in Minnesota? And yes, it is. And it appears to be the highest concentration in North America. It flows naturally to surface, not associated with water. So tick, tick. The next thing we need to do is this 10-well program, and that is the determining the volume. What's the size of the prize? And once we have that bit of information, and really that drill program, it starts in a couple of weeks at the end of September. It will go through to Q1 next year. And then at the culmination of that, so milestones, every few weeks there'll be a well completed. So that will be exciting. There'll be a resource update. And then we start to look at the economics for the first time. And so with a feasibility study coming out, we've got engineering works with Chart Industries who are looking to design the helium plant. So actually the news flow is going to be quite significant and dare I say it, quite good fun.
Take us through the process in relation to traditional mining. We've got many viewers and many clients who are invested in gold miners, for example. Is it dissimilar? Is it similar?
My background's actually hard rock, so I came from a gold and platinum and diamond background, and here I am in helium. But what I like about helium is actually the economics of it, and also just the process. It's actually quite akin to precious metals, because with it you never get a ton of pure gold, unfortunately. It'd be nice. There's always some sort of waste material there, and we talk about grade. And helium's the same. You never get a pure helium gas. So it's always mixed with something else. And so for us, grade is king. And so you could think of it that way. But in terms of the process, it's actually a lot simpler than mining because you don't need to drill, for some mines, you've got hundreds, if not 1,000 drill holes to determine the size of the resource. Whereas for helium, we're talking about a dozen or less to determine the size. And then when it comes to extraction, it's very quick. So the wells we've already drilled are set for production. They would then be put into a production facility that would be right there at the wellhead. And in terms of the overall capital costs, should we look at one of the, let's say, reach for the moon, the biggest helium plant in the world, you're still looking at a capital cost of less than $100 million, which when you compare to hard rock mining is actually quite modest compared to the usual capital costs you see.
Now, I'm very curious about this mix that you talk about, Tom, because, I'm very, very fascinated by gold and gold miners. And there's a saying, right? If you find copper, you're likely to find gold. Mm-hmm. What is the mix when you find helium? What's in it, in that mixture that comes out? And can you sell a byproduct?
Yes, you can. So there's typically three mixtures that you see. So one is the current model is helium with natural gas. The next one is you've got helium with nitrogen, and nitrogen doesn't have any commercial value. And then you've got helium with carbon dioxide, and that's where we are. So with CO2. And I must admit, to be honest, when I first saw that we had high helium, which is fantastic, but then there was high CO2, I thought, jeepers, what are we going to do with that? And the first thought was, well, we've re-injected into the ground. And actually in the US, you get paid for doing that. So it's quite a neat little system there. But
nice, a bit of payback.
Exactly. So it's funny when you think about it. You extract something and get paid to put it back in the ground immediately. It's quite an unusual business model. But actually, in the United States, there's a big CO2 shortage, and where we are in Minnesota, it's really exacerbated because it's quite displaced from the CO2 production. So for us, we would be looking at a combined helium and CO2 for the economics.
You mentioned Minnesota. I believe you've got operations in Greenland. Is that right? Are you looking at any other places?
We're very happy with our portfolio, to be honest. And of course, I'm going to say this, but I think we do have the best helium portfolio out there. And the reason I stand by that is that these are new discoveries purposely for primary helium occurrences. We don't go out with old known systems that have been exhausted for natural gas and now try and get the last bit of helium out of it. That's not our business. And so really I think Minnesota and Greenland are the places to be.
You also have just raised some 3.7 million pounds across the UK and Canada. How are you going to use these funds, and where exactly are you going to target these funds in the near term?
So this is really for the drill program at Topaz, so for drilling up to 10 wells. So the majority of the funds will go to that. Then we'll have the resource update, and then look at the economic studies as well. So that's really where the money's being deployed. It's all going into the ground in Minnesota.
We've also seen that university banks not only boosted its equity stake to just under 5%, but also expressed an interest for more. How transformative is this financing package towards production?
I mean, it's such a wonderful vote of confidence, firstly, from a US banking institution to see the opportunity that Pulsar represents. So really, we're very pleased. And at the stage before, we've announced final investment decision to know that one of the key things, which is the money, is indeed available for us, is a huge de-risking for us. So look, we're incredibly pleased with it, and really, should we get to that point where we do transition towards production, then we could do it a lot faster than if we didn't have University Bank there. So we're very grateful.
Now, Tom, you're working really hard towards commercialization, right? Very soon, some 2027 is what I've seen. You've also extended an existing credit facility. What does the funding pipeline look like before 2027?
So with the money that we've raised recently, so £3.7 million, that really gets us through for the next 12 months. So we budgeted for that. And then the intention is to go across and switch to a debt model as quickly as possible. And one of the, quite selfishly, reasons for that is that I'm the third largest shareholder in the company. I would really like to, see if we can avoid any future dilutive events as well. So certainly very much looking after the shareholders' best interests there.
Nice, you've got skin in the game, as they say. The move as well to acquire quantum hydrogen effectively expands your Minnesota land package by a big number, actually, by around 1,000%. How does this affect your growth profile?
Really what it does is it consolidates our position in Minnesota. So we're the first mover there. We've made this wonderful discovery at Topaz, which is where our efforts are focused to realize its production potential. But at the same time, we have to capitalize on that first mover approach. And over the years that we've worked there, we've really come up with what is the Goldilocks zone for finding this helium. And this ground that quantum has, it really fits into that. And so the way that I see it is that this could provide future growth for the company. So we get Topaz online, and then to get additional feed potentially from this area that we've looking to acquire.
Now, we've got two questions from clients. Thank you for sending those in. One of them being momentum in land acquisitions and financing. Are we going to see more M&A, strategic partnerships in the coming months, Tom?
Well, it's been quite thick and fast recently, I must admit. So, look, I would say that we always keep our eyes open for opportunity. When I say opportunity, that is in the area of interest in Minnesota. So we may well see additional activity there. And then also we're very excited because the state of Minnesota itself is soon to be leasing state land as well. And we've certainly expressed our interest in that too.
One from Paul, all the way from Spain, actually. With helium prices surging and supply chain fragility made worse by global geopolitical tensions, he says, how is Pulsar Helium positioning itself to ensure stable, long-term supply contracts and mitigate the impact of market volatility for your end users, especially as major industries like chips and healthcare increasingly view helium, and rightly so, as a strategic resource?
Well, buenos dias. And look, I think that it's quite a long question there, but I think that really, it is very strategic. We're seeing that certainly with the technical applications, with a lot of talk about defense as well. Defense is ultimately a very large user of helium. And really, the whole reason why Pulsar exists is to get to the answer to this question, which is guaranteed security of supply. And this has been the issue for the past 2 decades, is that you've got these big defense companies or big AI companies, and if they want to increase their product, then they will need guaranteed certainty with helium, which quite frankly doesn't exist. But compared to the overall costs, it's a tiny fraction, but it's imperative that they have it. And so for us, what I'd like to see is meaningful production from Topaz in Minnesota, not just a small little blip, but actually a meaningful contribution to supply, but also to bring that stability. It really doesn't exist at the moment. It's a very fragile supply chain, only a few sources. And as a primary supplier, what we could also do is perhaps even create a spot market for helium, which doesn't exist. So to give that flexibility, and then hopefully all those concerns are a thing of the past.
And last but not least, I'm going to be devil's advocate. helium is, of course, finite. So does that not mean that prices, are going to be on an upward trajectory because it's finite? But also, what is the next leg for Pulsar helium? Because all commodities, as we know, Tom, it's a receding resource as opposed to growing resource.
Yeah, look, very much the case. And so helium is finite, and what we see actually is there's talk about companies going out and looking to mine the moon for helium. So I'd like to think that there's still plenty of opportunity here on Earth. So it's not quite that dire yet, but we've got Minnesota. It seems to be quite a sizable occurrence. And we know that from the subsurface work that we've conducted. We also know that there's been some drilling as far away as 150 kilometers from where we are, and they're still getting multiple % helium. So this looks like it could be quite large, which is great. So everyone could have, hopefully breathe a sigh of relief that we're not running out and we don't have to go into a different planet just yet.
Not just yet. Thank you so much for coming on, Tom. It's been such a pleasure. For all of you wanting to ask the CEO of Pulsar Helium any questions, send them across to ask@ig.com, which comes to me, and I'll put it in front of him. That was the wonderful Thomas Abraham James, CEO of Pulsar Helium.
we get here? It's Thursday, September 11th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Thomas Westwater in Chicago, Dylan Radiganoff. The rest of this week will be back with us next. Here to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're on the platform Tasty Trade on the website, tastylive.com, come over to YouTube. Tell us what you think of this action, how you're trading it. A push by stocks after the CPI report and the weekly jobless claims data to fresh all-time highs in the S&P 500. The NASDAQ doesn't quite reach a new all-time high, but does close at what would be a closing high. The Russell is your leader here today, though, up 1.78%, a real astounding run for those small caps, which see more rate cuts coming down the pipeline. The equal-weighted NASDAQ and S&P both outperformed their market cap weighted as well, just to show how strong breadth was in today's session. But a decent 30-year auction after yesterday's strong 10-year auction has bonds and notes pinned to the upside. We can make an argument, as I'm going to in a little bit, that the market cares more about labor than inflation moving forward, and perhaps already has for the past several weeks. Gold doesn't bounce, but silver roars back above 42. Energy has been breaking down, and the dollar is not down itself, but not in a great spot.
No.
Thomas, you and I have been talking the last few days. I know that you were coming into the CPI report looking short, just like Ilya was. I'm assuming, like Ilya, with today's action, you have decided to close up shop here, potentially in your short call spread.
Yeah. I closed that this morning for a small loss. Didn't like the way the market was looking for that position. I tried to, hedge the reaction if we got a soft CPI by being long gold. It turns out I should have went long silver. Not too much working out from yesterday to today, but the market definitely, flashing a sign of optimism here after this event risk is out of the way, and it's like we're just greenlit for a move higher into next week's FOMC.
Oh yeah, the initial reaction for stocks this morning was for weaker equity prices, but within 15 minutes we had erased those losses. Yeah. I couldn't help but notice that jobless claims showed a spike to 263,000, which is the highest level of claims that we've seen since October 2021, when we were still climbing our way out of the pandemic.
Yeah.
Are we effectively going to look through inflation now until we see signs that the labor market is not destabilizing?
I mean, it's an interesting thing because there's a lot of conversation today about that jobless claims thing being a one-off thing in Texas.
Right.
And that having kind of shaded the data. So we'll see how that goes. I mean, obviously the NFP number was god-awful, especially when you consider the revisions. We got a set of revisions that basically meant we added on net, or at least the jobs picture moved on net 1,000 jobs to the good, because we got a 22K monthly increase and a 21K adjustment down for the preceding two. So not great, obviously. The question for me really is, what about this don't we know yet? And it comes back essentially to the same thing that we've been talking about this week and for a while, that we're going to get a cut next week is not the object of speculation. There is no speculating that's left to be done there. In fact, interestingly, after today's CPI, the likelihood for a 50 basis point cut actually went down. And certainty cemented closer around we're going to get a 25 basis point cut next week. We've known this. It's been north of 70, 80% for months. Now it's cemented around 95. This is a given. So, yeah, the labor market looks weak. And the Fed is going to respond, and we heard it in the rhetoric at Jackson Hole. We know this. The big question that's left, the place where there is room to speculate, is whether the Fed will come the market's way on extrapolating the easing cycle. Because still, for next year, the market's at 75 basis points, and the Fed's at a quarter as of June. So I think what the markets want, not necessarily for the Fed to go to 75, I think that would be somewhat panicky, But if the Fed went to 50 in the summary of economic projections next week, the market would go, okay, they're seeing what we're seeing. They're being responsive. They're going to make an adjustment here. We still got another meeting, and then another meeting with an SEP update in December. This gives them time to kind of spin the narrative and see the data and come our way. But the market's going to want to see that. And if they don't see that, as some of the inflation data that we saw this week might sort of signify, were you a Fed official that's more concerned about inflation than employment per the last set of FOMC minutes, then we might be in for a risk-off kind of outcome. But I don't think there's anything in the jobs data that the markets don't know immediately. I think the real question is, what's the Fed prepared to do about taking next steps?
What I find particularly interesting about this report today is how, while we don't get movement on the 50 basis points for September, what we do see is that the market kind of solidifies odds around October and December here.
That too, yeah.
What I mean by that is, after today's meeting, we're now looking at a 97% chance of a cut in October and a 90% chance of a third cut in December. How much more juice do we have to squeeze out, right? Like, you're starting to make a case where we have to get a fourth cut priced in for this year if you're talking about much more easing as a potential driver. So big picture right now, though, VIX is back down to the session lows, right? We have this flash down this morning in the pre-market. We end up rallying back a little bit. We're closing down below 15. Equity markets here are up on the highs. They just had Adobe earnings here after hours, by the way. They guided a little bit higher outside of their range, but we're seeing that the share prices are coming back in a little bit now that we've had some chance to digest the move. Guidance was $2.51 billion expected. They guide to about $2.53 billion. Revenues were up 11%, which was in line with expectations, yada, yada. So we're up at 351. We'll call it at the close. Now currently 358 after hours, hit a high of 382. Oracle is a company, obviously, that's been in everyone's mind this week after its astounding performance, surging, and that's ORL, not ORCL, which is what we're looking for. They were down 6.27% today, although after what happened yesterday, I have to imagine that there were some fund managers who were like, yeah, we got to reallocate away from this today and start to...
Yeah, and they did miss on earnings. I mean, the whole thing is guidance. And
Benjamin Graham rolls in his grave.
It was obviously, it was a story the market wanted to hear.
They missed on revenue and missed on earnings, and the share prices jumped 40%.
Right. Because the market's like, wait, but in the future, it'll be cool though, right? Okay, great.
And the last time Oracle had that move was 1999, and what was happening in 1999?
Yeah, I mean, Larry Ellison has just lapped Elon Musk as the richest man in the world. On paper, obviously.
Didn't see that coming.
What does Oracle do besides make Larry Ellison richer? It's incredible how they've remade the company, by the way, in recent years, when they went from being all enterprise and now they're going to be hosting OpenAI. Okay, Elia, so I think it was easier for me to get off of my August hesitation, where I flipped from being someone who was bullish to a bit more directionally neutral, looking for vol expansion, and it just ate me alive in the first 3 weeks of August. And I had to have my coming to Jesus moment, like, Dylan, what do I do? And he's like, don't think. Why think? You're so dumb being a thinker. Be smart and don't think about anything at all. And yet that works, and it's been working.
I mean, it works until it doesn't, of course.
Sure. So what is it going to take for the market to lose what I'm colloquially referring to as the innocent until proven guilty market? Or kind of like the boy who cried wolf market?
Yeah, I mean, I think we've been talking about this really since the market got into the range that it's been in since mid-August, that it just finally cracked today. And boy, did it. I mean, NASDAQ didn't, but S&P absolutely did. I mean, just look at where you're at here in the S&P, and
the Dow as well.
Dow, I think Did Russell make a new high? I think it did.
Yes, it did.
I think it did. Yeah, so I mean, thankfully, I didn't have any exposure in either of those. I just had the S&P to deal with today. But we've seen that the market through that range was essentially reluctant to rally on good news because we got plenty of good news. All the Max 7s reported well, some of them explosively, like Meta. NVIDIA survived. The data has been going in the direction of Fed rate cuts, which the markets want. And basically from mid-August until today, the market would not make a concerted move like it did finally. And so were we to have had some bad news, who knows where we'd be? Because the market didn't want to make hay of good news.
But
we didn't
what was
really
good
have
news?
anything.
What was the good news today for the market? Inflation was up 0.4% month over month. Maybe is it the core goods?
It didn't surprise.
Core goods X vehicles were at 0.55% month over month in June, and now they're down to 0.13%. 0.13% in a tariff category means the Fed can look through tariff inflation, if that's what this is.
I mean, I think it was very simple for the markets today. I think they looked at a CPI report that they perceived to be a risk, come out directly on the screws across the board, but for the monthly headline figure, which was a touch hotter. But the year-on-year figures across the board, and most importantly for the core, came in exactly as expected. And I think there was a collective sigh of relief. That essentially, look, the rate cut's coming, everything's okay. And we're going to see if this lasts beyond a day. Because we see the last CPI report lasted for about 24 hours. Under these same circumstances. The last update on policy from Jackson Hole, same thing. Mag 7 earnings didn't do anything. In fact, the market faded them. NVIDIA got faded. It was good for a day. We'll see if there's follow-through here, because I'm not sure the market's learned anything new. It was a 93% a chance, 92% chance that we'd get this cut. Now it's, what, 94, 95? Huge difference.
Yeah, with respect to that data this morning, if the spike in the Texas claims might be due to some of the flooding that occurred recently. Right. Someone just sent this to me actually on Twitter right now, so thanks for that. This is on the Texas Workforce Commission's website. The unemployment assistance application for the Hill Country flooding were due a week ago. So that was kind of like the last chance for people in Texas to get their foot in the door for some of these filings. And it's an unseasonal spike for a natural disaster reason. So it doesn't mean it's superficially enough to convince the Fed that they need a cut, but it doesn't say that the labor market may actually be that weak. It could be a one-off reason for why jobless claims spike this high. And over the past several years, when we've had hurricanes, we've seen jobless claims jump into that 240, 250, 260 neighborhood, if ever so briefly on a week or two basis, and then come right back in. But we're going to have the Fed next week, guys. So are we setting up a buy the rumor, sell the news type of Fed meeting here? We have basically 3 cuts priced in, Thomas.
If a sell the news event is going to happen and you're expecting it to happen on FOMC, maybe it would make more sense for it to happen tomorrow, since it's already locked in. Tomorrow, it's before the weekend that the Fed happens. It's triple witching. It's, you got the contract roll next week, which a lot of roll pressure already being going to be exerted tomorrow probably. So if it's a sell the news event, wouldn't it make sense to take off the risk tomorrow before the weekend?
I think it might. I think that's a very good point.
If you're to take the risk off tomorrow morning, why not just take it off today before the close?
I mean, you could do that too, but obviously,
because Asia and Europe have not taken stock yet, and so you're probably going to get to open relatively well tomorrow because it isn't just U.S. markets that we're watching this. Asia and Europe are going to have, in Asia especially, obviously, because Europe had some overlap with the data today. But they're going to, there's no fuzz. There was an ECB meeting overnight. It didn't do anything, but there was one. And so that's a level of event risk always. So I would suspect markets probably wanted to let Wall Street digest its data. And we're probably going to get a little bit of follow through from Asia and from Europe. Overnight.
Sorry, something you just said really just got in my brain. Did you say the ECB meeting was overnight?
Yeah. The ECB just met.
Yeah, at 8:30 a.m. in the morning.
Well, overnight for U.S. markets.
Okay, so do you consider like CPI an overnight release? Because they're at the same time.
No. CPI would be this morning. But for Europe, CPI was sort of afternoon, and for Asia, CPI is overnight. And Asia hasn't responded.
You didn't work on the Asia desk, Chris.
I did. For me, anything before 9 a.m. Pacific is overnight.
So
that's psychotic. Go on.
Is the macro risk now that, rate cuts are coming, but the labor market continues to deteriorate?
I would think the macro risk now is that the Fed isn't going to cut as much as the markets have already baked into the cake, and that creates a mispricing risk.
I wouldn't say you're wrong, but what are we mispriced for this year or next year?
I think we're mispriced for next year. I think for this year, I think there's room to take away some of the lean on a third cut now that we've sort of built one out. It's not that convincing. I mean, we're looking at 64 basis points that's priced in for this year. So that's 50 and 14 basis points in the direction of a third cut. So that's about a little bit over a 50-50 shot on a third cut. Once you sort of look at the cumulative picture. So 50 basis points are in, you're about another half way, a little bit more in the direction of a third. By the close here, once you sort of adjust for dates, the CME FedWatch tool had that third cut at about 70-odd%. So, okay. I think there's some room there, maybe. I think maybe the Fed only is in the market for 50. But the big story, I think, is next year. I think the market wants the Fed to keep cutting. And I'm not sure the Fed is as ready as the markets want them to be. I mean, the markets have 3 cuts on the menu.
So do we think the dot plot, or if one or two members votes for a 50 BPS cut, does that, do you think that affects rate cuts for next year?
Well, I mean, I think today, what did we say? The rate cuts for next year were wiped out by the end of the session. Whatever bump we got in the SR3Z contract, as we see here on the screen, is completely disappeared. The moves that we're seeing are really for this year, right? The market saying, "Oh no, the Fed has enough confidence, to do something now." Right? They're not going to have to wait until next year. The help is coming sooner than we thought.
Hence, that third cut starting to look narrowly better than even odds.
But if it's for a reason like a one-off because of Texas flood insurance, and next week's the Fed meeting, I mean, how are we going to get from, I want to know how we get from 0 to 1 in like the sense that how does the market not walk away disappointed at all now that we've basically fully priced in 3 cuts? Because the Fed could give us one more, so directionally we're going there. But what if the Fed doesn't give us another one? Because it's a 0.4% month-over-month inflation rate.
I'm saying that's the thing. I think the markets are so out on a ledge here that it'll be difficult for the Fed to kind of meet that bar. But I don't think the market wants them to be hysterical either. So I think what they'll want is motion. If the Fed comes out and goes, look, here's a 25 basis point cut, We see your weak labor market. We're less precious about inflation expectations, though we are concerned, and we're not ready to jump out the window here and say that they don't matter. But we see what you're saying, and here's an extra cut that's in the forecast for next year to kind of show you we're serious. And I think that's reasonable. I think the market wants to believe the Fed because stock markets want to go up in general. And so I think they're inclined to want to hear what the Fed says as long as the Fed gives them something and says, here is motion in your preferred direction. Now we'll see you in October, and then we'll take another baby step, and then we'll see you in December, and we'll update our summary of economic projections then. Not unlike we saw last year, where the Fed came out really ultra dovish in September, and then once the markets started to kind of worry about what that meant, they reeled it back in December.
Guys, if the GDP readings are sitting close to 3%, the unemployment rate is 4.3% or lower, and inflation is sitting near 3%, is the Fed embarking on a maintenance, an emergency, or a recession rate cut?
At 3%, I think they clearly see that what they're doing is anticipating that inflation will not be a problem downwind, and this doesn't smell of maintenance. This smells like they're trying to respond to some sort of business cycle outturn that they want to get a reasonably timely response to, because this would not be maintenance at 3% inflation, which is well above target, were the Fed not thinking that the path downwind is going to be meaningful disinflation for some reason.
Thomas, where do you land for next week? Maintenance, recession, or emergency?
I mean, I kind of agree with Ilya. I mean, a maintenance cut, it's kind of like, inflation has been the worry about if it picks up, not, if it does it in a substantial manner, and we haven't seen that. So responding to labor market conditions makes it a little bit more of a cycle cut, or responding to conditions. So I'd probably agree more with Ilya.
I'm having a hard time interpreting it as anything other than a maintenance cut, because if you're worried about recession, you're going to do more than 25. So if they give us 25 as the markets to understand it, which quite frankly wasn't my base case. My base case was 0 or 50. But if we're going to get 25, then you view it as a maintenance cut because you have a few more tinkering of the knobs coming. And I just think the median market participant is going to look at 3% GDP and a sub 4.5% unemployment rate and think anything other than, well, the Fed must feel pretty good about the state of the economy and that inflation's not an issue, like it was last year. Not as reflationary, but certainly with that potential.
I mean, if your sense of what a maintenance cut is something whereby the Fed feels it isn't careening into a recession necessarily, I agree with you. I don't think the Fed thinks that they're careening into recession necessarily. I do think they see the labor market weakening, and they want to do something to ensure their soft landing goes well.
The labor market's basically frozen.
Right.
70,000 jobs a month.
We heard this from Powell at Jackson Hole, right? He was like, you know what? There's a kind of strange balance in the labor market where nobody is getting fired, but also nobody is getting hired.
Right. No one's getting hired. There is the hiring-firing ratio, which has started to dip into negative territory, which shows that at the margin, people are losing their jobs. Every 100 people that lose their job, only 95 are getting back and filling roles, kind of situation. So it's not great. All right, so we have a NASDAQ above 24K. We're going to have an S&P 500, maybe 6,600 again. We touched there briefly here in the market during the run up to the close. Ultimately, Ilya, it's a day where the market is led higher. It's basically every sector that's up. It's only energy that's slightly weaker. But on the top end, it's home builders, ITB, XHB, top 2 performing ETFs. You have gold miners, junior gold miners sitting near the top of the heap as well. But I see a lot of rate sensitive things, XRT, XLY, VNQ. While the tech names aren't the frothiest in today's session, I do think ultimately this has to be one of those signs that if I was a bear, right, there's now a broadening out of participation in this market. That sideways chop where the S&P was moving up to highs and the rest of the market wasn't. It was really just the big names doing it. RSP now, the equal weight ETF for the S&P, is now at a fresh all-time high and closing high here on today's chart. So I guess like I could stand up here and, you know, I like to review, obviously, and you like to review, and this is how the relationship works. And so when people start sending me, when people start sending me, and we have sentiment checks, and I give it, I'm self-reflective about all this stuff, right? If I'm waving a sword around on camera, you're probably near the top. But I find myself in a world where volatility is low, volume's gone. People, as funny as it is, they are sending me messages on Twitter asking me to ask you questions about your short positions, which has only happened a handful of times in recent years. And every time it does,
I'm so happy I didn't get rid of all of my short position. This is such a sentiment.
No, but it always happens near a top.
It always happens near a top. I love it.
And so
I'm so happy I didn't cover all my shorts. This is great.
No, and then like you get out of your, well, I mean, Ilya, I'm going to tell you a long story here. Left shoulder, head, right shoulder. This is a big inverse head and shoulders pattern in the stock market up here. I'm going to spin you a tail. You want to spin you a tail about where the market's going.
We can spin this tail too.
Right. But as people who have been looking for taking shots on the downside, which I've tried to understand, it hasn't been successful. I went back to my old ways. It's working again.
Yeah.
How do we reconcile this if this is a market that is based on inappropriate valuations, bubble-like conditions, AI hype, this, that, the other thing, easy money coming back down the pipeline? How do you time all of that out without bleeding out death by 1,000 paper cuts, which, I know a lot of us are contrarians around here, but being able to stay in the game matters more than being right or wrong at any given moment.
100%. And I think that's exactly how you do it. So let's use the S&P as an example. So the S&P was in a range from mid-August until today. And when it got toward the top of that range and started to look like it was making lower lows, you started to get the sense, oh, well, okay, so I know where there is a point against which if it breaks above, I'm wrong. So I have a range top. I know that if it breaks down and the move has followed through, there's an asymmetric opportunity. Because if I'm wrong fast. We're near the top. It breaks as it did just today. Okay, it broke. Cool. I'm out. Good night. But you have to think about how to structure it, not just in terms of price, but also in terms of being covered in a risk-defined way, in terms of buying the vol when it's cheap like this. Because, I mean, an S&P put here is dirt cheap with IV rank of 10. I don't think there's any reason to want to bet that way here. Now, you just had a breakout. But I think when you get those kinds of setups where it looks like momentum is lost and vol is cheap, and you can structure it, let's say, as I did, with SPY ETFs to bring your position size down even lower than MES, and take a small kind of poke at the market and say, okay, well, if this follows through, it's asymmetric. If it doesn't follow through, it's a small loss. Okay, fine. But also, you're not operating in one instrument. My small loss on the S&P was overwhelmed 3 times over by the positive P&L I took from sitting on a long TLT position and sitting on it for almost 80 days, waiting for it to pick up momentum finally.
Okay, so if we're talking about the Fed meeting in particular next week, though, the Fed meeting as it stands, we're 6 days out, has lower IVs compared to where we stood 6 days out from the Jackson Hole speech from Powell, or from the Thursday ahead of the 6 days out from the non-farm payrolls report last time around.
Yeah,
it's almost like the CPI report and the Fed meeting are being viewed similarly.
Well, and I think to a large extent, the CPI report was probably the nail in the FOMC forecast coffin. For
why?
Markets. I think that was the last thing that could have spooked expectations in an uncomfortable way, because I think the markets do like the certainty of it having passed without incident. They knew what they were going to get. They, I think, knew what they wanted to see as far as Fed policy expectations. Those were baked in. But there is always the uncertainty that the number comes up weird. I mean, we just saw the NFP number come up very weird by a big margin out of the same BLS. And so I think there's the event risk itself. There's no more event risk of significant consequence unless the University of Michigan inflation expectations counter that's coming out inside the consumer confidence survey tomorrow goes off the charts and the markets go, oh no, the Fed isn't going to like this whatsoever. I mean, inside this inflation report, just for the record here, we had the third consecutive month of positive and accelerating goods inflation. Moreover, it was the largest increase in core goods inflation since January, and the year-on-year growth rate in goods inflation accelerated to the highest since May of 2023. So it's not like the tariff inflation isn't making its way into the data. It is. It was services, actually, that took CPI a bit lower, or it would have been hotter. So the tariff pass-through is there. Those things that the Fed doesn't want to see, they're there. If consumers start to bug out about it, the Fed's going to start to think, well, we don't want this thing to get entrenched into inflation expectations. Oh, and by the way, we've been screaming through a bullhorn that we're never going to let that happen. At Jackson Hole, at the last press conference that Powell did in July, on and on and on and on and on it goes. They've been pounding the table saying we're not going to let this get into expectations. So I think the market saw event risk move out of its way. And unless something really untoward happens with U of M, then the next thing is the Fed, and we already know what they're going to do.
Thomas, do you think U of M tomorrow is going to be that thing?
I don't. I just don't think there's enough.
Doubt it.
Yeah, I mean, anecdotally, you look at the public view of inflation right now; it's pretty tame. I don't expect to see that. I mean, there's a chance it could. If it did, I think the market would definitely take notice.
It jumped last month.
Yeah, I mean,
Thomas, could you give me something else to work with besides the Fed here? I've been looking at some of the ag today. We got to get something that's not equity in our portfolio as we get into the Fed week here. I tried doing something in natural gas, which is a disaster.
Yeah, natty gas is not working today. Let's not talk about natty gas. There's WASD tomorrow. There's WASD.
Yeah, that's what I want to bring this
Talk
event risk
about
up
being
for.
gluttons for punishment. I want no kind of exposure in natural gas. You guys keep it.
Yeah, that one's not fun to watch today. Yeah, WASD's tomorrow. The World Agricultural Supply and Demand Estimates comes out every month. So the trade desk estimates, we're looking for a small drop in production for corn, and then a smaller drop in production for soybeans. So I'm long both corn and soybeans. I'm doing it through selling put spreads, with now some room under that. So what I'm expecting to see, or what I'm hoping to see, is those production estimates come in a little under the estimate. So I think we can get more upside, especially after the very long sell-off we've had in the market where positioning has gone quite extreme. And what you've seen the past month is some of that positioning roll back to more normal levels. So seasonally, corn, we're going into the harvest. Seasonally, there's downward pressure because of the new crop. Everything the farmers you're going to see out on the streets, out in the fields harvesting their crops, that goes into the new supplies. So you see more supply come on this time of year through November. But we're coming after a time where, the USDA has really raised their crop estimates, ending stocks, production all up to near record levels. So this environment, a disappointment to the downside, could really be something that sparks some upside movement and gets more of that positioning that's left over from this multi-month sell-off. So yeah, I'm trading it to the long side. And at this point, I'm a little insulated from downward moves because I've had these positions on for a couple weeks in corn and soybeans, and we've had some market reaction to the upside. But this report comes out at 12 tomorrow, so you definitely expect to see some movement in soybeans, corn, maybe wheat, and then those other products we don't trade. They include things like cotton and other stuff.
Yeah, unfortunately, I tried getting a short iron condor today filled in the beans before the market closed, and volatility, the IVR was up in the 80s, but it has come off quite a little bit here. I still think it's a viable trade, though. Tom is thinking about finding things that we can put into our little bucket of holdings right now as we get ready for the Fed. Yearly high is near 1,076. The yearly low is near 970. Something like, and we'll have to wait for more liquidity to come back in the market, but something like a short iron condor trade, if we can get better than a 4-to-1 around those levels, it seems like it's something viable to play with right now from my vantage point. Just if only to, again, if you're directional in bonds, stocks, the dollar, metals, and that's really what you're doing there, then having something that's not a directional play, that's uncorrelated with everything else, can serve a benefit. So just something to think about for tomorrow and as people prepare for next week. Corn to me is the most interesting one, perhaps now at the end of the session with the 60.2 IVR and that downtrend in place from the April, May, June, July swing highs is seemingly breaking. So when commodities go, they tend to trend. They tend to trend for a long time, and maybe this downtrend is wrapping itself up right now. We'll have to stay tuned for more. Ilya, are you still holding long gold today?
Yes, I am.
I got back on.
Me too.
Yeah, look at us.
There we go. Come on in. The water's fine.
All right.
Yeah, I don't see any reason to get off this boat. I was actually kind of encouraged that gold didn't have the best of all days today. If it had a big ripper of a day, you'd think that everything is kind of priced in, and the idea that the Fed is a buy the rumor, sell the fact kind of a thing starts to be a concern. Gold hasn't been very responsive to sort of Fed-related things the past several weeks. I mean, this rip in gold, obviously, is going all the way back to the beginning of this month, stands in stark contrast with how long it took the bonds to get going and how long it took stocks to get going. S&P really only got going today. The situation in the dollar, which still is kind of bottoming-ish, it still hasn't made a fresh low since July. So I'm looking at all of this, and that gold didn't revel in this today actually gives me a little bit more confidence that it's off on its own mission and the trend is there and it will continue. So I'm sitting there. I did take the bonds off, and part of that was I was coming up, I was 8 days to expiry on my 80-day verticals. And so it was time to make a decision. And obviously bonds have had a monster run. So I figured it was only right to take that off as well, alongside the S&P position, which ended up being a nice day overall. But I haven't reloaded on those. Were I to think that there's going to be a follow through, I probably would have. ZB now looks a little heavy, maybe. At least,
Thomas,
at least heavy enough to kind of take a step back for a second.
Thomas, I got out a few days ago and was feeling some serious FOMO, but the action where since April 22nd, we've seen these tests of the 1 week moving average, and they've served as a springboard for gold just to continue trudging up. We had another one of those today, so I used the opportunity to get in back on a long position here out at 47 days and a little bit more constrained than usual, not quite the $50 or $100 wide strikes, but only $25 this time. The long, the 37.50, short 37.75. I say that because where do we stand in this potential breakout? We do have a triangle that's formed here, and if we use the swing lows post-Liberation Day up to the high, back down to the low, 37.47 we'll call it, is your extension target, just eyeballing it. And so playing for a little bit more of a rally here to the top side is of keen interest. Why did you get into today? If it wasn't for my 1 week moving average, and I'm going to hold this until we break below 36.50. If we're below 36.50, I'll get out and reconsider. Why did you get in? What did you see today that made gold appealing to you?
I'm trading this kind of like a bull flag pattern. You know, we had the big move up. You get some consolidation.
Like you called out on silver the other day.
Yeah. Which, you know, said I'd rather be in silver, but I looked at them, picked gold. I think the better thing to say is there's a smaller chance of going down than there is up. So, you know, we have rates coming down, naturally good for gold. You have a stock market that is, you know, you could argue is potentially getting kind of frothy. You have political instability, and in Europe as well. I mean, you have deficits rising. So, I mean, structurally, this looks like a really, you know, strong time to be gold. Not only short term, I'm, you know, my view on gold probably extends into at least the second half of next year. So I think, you know, the move we've seen over the past 2 months, it could just be really the start of the market seeing what's going to happen over the next year or two and starting to price this in.
Thomas, silver's at the top side of the range. You were calling out this being a flag a few days ago, and I made a case yesterday here, Elliot, that 41 is the line in the sand. As long as we're above it, there's nothing to do but be long silver. Thomas, this is also a very difficult entry point if people want to get long right now because we haven't cleared out range highs. How would you approach this market if you're not in? Assuming you're not in, but if you were looking at this with fresh eyes, do you get long now or do you wait for a little bit more confirmation to the upside?
I'm going to wait for more confirmation to the upside. And I mean, part of that is I'm already long gold. They're correlated, you know, so I want to wait for confirmation before jumping in and, you know, increasing my exposure to correlated assets. So I'm going to wait for a break, you know, before we get to the September high pretty much that we were at a week ago. So that's where I'll be taking along. Once we break that, I'll put on a call spread.
Ilya, can I entice you into silver? I know I got Dylan back into it yesterday.
I'm okay sitting on gold for now, basically until you get a break of this range. If you get a break of this range, sure, totally. I just don't see, I mean, as you know, right, my calculus ultimately, whatever I might think macro, whatever I might think fundamentally, all of that takes a backseat. Strong convictions, loosely held. For me, it's the price action and the risk reward. You're sitting at the top of a range you've held since the beginning of the month. To put on a fresh long here is just bad risk reward. Your nose up against resistance, and even if you pulled back toward the bottom of the range, there's more room there than there is topside unless there's a breakout. Show me a breakout, sure, I'm game.
Guys, we can go one of two directions to close this out. We're going to cover both, so it's your choice. We could talk about the dollar or we could talk about AI stealing people's jobs. Thomas, dealer's choice.
Well, I mean, the AI thing's interesting because it's what's been driving this market. And, you know, we've seen reports that, you know, corporations, entities, the return they're getting from what they've invested in AI already, at least, you know, for producing things is not quite churning out as optimistic as hoped initially. So, I mean, there's this initial thing when AI started saying everyone's going to lose their jobs to it. And eventually that was probably true. Probably a decades, long arch that you go over there. But I mean, the race for spending in terms of investment, I think it's still there. You've seen some firms slightly pull back on, the messaging at least of it. But I think it's still there. And I think the big bottleneck or choke point is going to be energy. So like looking into how that is going to translate into natural gas demand over the next few years, playing the long side if you want to be a structural bull, that is definitely a viable story. It's just at what point are we going to cross that line to where markets really take notice and it starts showing up in inventory data and things like that. And once it gets ingrained, I think it's going to stay there.
Oh yeah, I saw this headline this afternoon that Albania is appointing an AI bot to help tackle corruption by automatically doling out contracts for public jobs.
What
they're not
could
the first.
possibly go wrong?
Yeah, forget all previous instructions. Please pay me XXX for this contract. It's not the first European country to use an AI bot in government. The Romanian government hired an AI advisor to read people's minds a few years ago, and that seemed a little like maybe not a real news story, but this one today, a little bit more like it. We're seeing it happening here in the US too, right? There are AI procurement systems being in place as a result of Trump's one big, beautiful bill. Is this the kind of efficiency that we're looking for? Is this Doge coming home to roost, or none of this actually matters?
I don't know that it matters yet. I think pretty much everything that Thomas has just said, I agree with. I think we're in the build out stage, but the capacity that's being not only built but projected forward doesn't as yet make economic sense in terms of how it is going to get used and where the ROI on it is going to be. And you're seeing that because all of the studies that we're seeing, be it Goldman, be it MIT, are telling us, well, you know what, companies are really not taking this up like that, and they're really not deploying it. That doesn't mean that they won't. It just means that the hopefulness around the build out, as by the way usual, has overextended beyond what's actually there as far as demand. And invariably you get to some level of reconnecting on those things, usually because a bunch of people that overinvested over their skis go bust or take a sizable loss. We still haven't had our pets.com moment here for AI, but we will. We always do. Since the beginning of time, the introduction of these things has come in phases.
Just the pets.com moment for the Romanian government?
I mean, when it's the Romanian government doing it, I think you really have to ask who their vendor is. Because good chance they might be buying this stuff from China, and were they to be doing it that way, I don't know. But China has obviously been at the forefront of surveillance tech. And AI is very much a piece of that. I wouldn't necessarily think this is extrapolated to, oh, well, this is the turning point for ROI positive AI adoption. It sort of starts to get a flavor, and I don't know enough about this Romania and Albania situations to downplay them, but it starts to sound a little bit like Nayib Bukele and building a crypto city in El Salvador. Yeah, okay. Okay, man. Cool.
Oh, that's why Dylan's not on the show. He just posted a picture with him and Guy Adami getting drinks in Italy. Okay, cool. All right. Yeah. Appointing an AI minister is one thing. Listen, the jobs, I was going back to what's happening in the labor market right now with recent college graduates, where the unemployment rate for college graduates, particularly for men, is starting to rise above those with only high school diplomas. Those in the STEM field, right? Last month, we saw the major tech companies' job listings coupled with overall firings, layoffs related to AI numbered around 10,000. It's a lot of people.
Yeah.
It's not nothing.
It's not nothing at all.
So if you know someone who's entering college, do you tell them to still go to college, or do you say do something like go to HVAC school or become an electrician?
Do HVAC schools have fraternities?
No, I think you tell them to go to college. Because I think the biggest premium after AI is on human ingenuity.
I see. I think college is more important now for networking and meeting people in a certain social and economic and financial
and for
sphere of
learning
life.
how to have original thought. So I think it's less important to learn how to code. It's more important to learn how to write a really great essay.
I think it's more important to learn how to socialize.
That too.
That like to me is the whole point of college, like learning how to socialize and get along with people that
how to speak publicly, how to engage with people.
Put 55 guys in a fraternity house with no laws and see how that sorts itself out, like Lord of the Flies.
There you go.
Right? Like
there you go.
That was more meaningful education than anything in the textbooks, because quite frankly, they didn't teach any of this stuff in the textbooks about interpreting presidential tweets and how it pertains to Fed policy, which I suppose is a way we can go out. President Trump here is going to the Supreme Court to get Lisa Cook fired, requested an emergency meeting on Monday. So maybe one fewer Fed governor available for next week. But Lisa Cook, listen, if she's really this corrupt person that people say she is, wouldn't she vote for more rate cuts so the mortgages on all of her homes go down?
You'd think, right?
Huh. Hell yeah, Thomas.
See, you're thinking again. What has Dylan told us about this? You got to stop.
No thinking, just doing. And we're done here on overtime. We'll be back tomorrow. No, just kidding. Next week, because it's Thursday. We're here every Monday through Thursday, 4 Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco and Thomas Westwater in Chicago, I'm in Chris Vecchio in New York. Good luck trading. See you next week. Come back for more, though, because Ilya Spivak's still here. He's with Macro Money.
See you there, everybody. We are back looking at a stock market that has finally found some momentum. S&P 500 jumping higher to a record and actually managing to close near there in the wake of today's U.S. inflation data. So are we off to the races? Are we in the clear? How does this impact our positions and what we're trading going into next week's FOMC meeting? Those are the things we're going to tackle here on Macro Money. This is Ilya Spivak, head of global macro here at Tasty Live. And we'll start with a conversation about how the markets performed today and why, what the CPI data showed us. Take a look at a little bit more of the event risk still looming in front of us from today into the end of the week with the University of Michigan consumer confidence data and the inflation expectations baked therein, and wrap it up with a look at our positions, how today's action changed things, what we took profits on, what we took some losses on, and what we still have going as that FOMC meeting next week gets front and center. Let's begin here with a look at the performance today. Obviously, a much more spirited rise for stocks here, and a much more spirited one for the S&P than it was for the NASDAQ. 0.8% added for the S&P. NASDAQ up almost 0.6%. The S&P, as we mentioned, just moments ago, breaking out to a new record high. The NASDAQ, not so. The NASDAQ still testing its high from mid-August, incidentally in the wake of the last CPI report before this one, and not making an effort to really clear it. So interesting kind of sogginess here from the index that contains the market leaders. Of course, it is still up, but while the S&P broke to a record high, as did the Dow and the Russell, not so much for the NASDAQ. So interesting to consider, but certainly a risk-on day. Yields down a bit more, bonds higher, especially at the long end, the 10-year down almost 0.5%. The front end of the curve holding basically steady because, as we'll see in just a moment, today's data did virtually nothing for near-term Fed policy expectations for specifically next week's meeting, but there was a little bit more moving around in the longer end. Crude oil, again, back down toward the bottom of its range, but ultimately not going anywhere, still oscillating. And gold not really finding the kind of support you'd think from a dovish kind of read on inflation data. A little bit soggy, but ultimately not getting away from recent levels and more so consolidating than falling. The dollar a little bit softer, interestingly, more so against the euro, where there was an ECB policy announcement overnight where the Bank of the European Central Bank, signaled that they're probably done cutting rates. The yen echoing what we saw at the front end of the yield curve and basically flat. Bitcoin a touch higher in the sort of risk-on overall theme here, certainly emanating from stock markets. Yen, interestingly, steady because this is probably the most nakedly yield sensitive of the major currencies against the dollar, and it seemed not to find a strong lead today. On the week, we do have a decent Bitcoin rebound. Yen ultimately a little bit higher, the euro a little bit higher, but only just so. The dollar really holding impressively here, all things considered. Gold up about another 0.5%. The real big story, the strong push in stocks, needless to say, almost 1.6 in the S&P, 1.4 in the NASDAQ, and the sell-off for rates at the long end and the push higher in long end bonds. That's really been the story of this week, as though the markets are sort of envisioning rate cuts downwind beyond what we're about to see. In fact, as we can see here at the front end, yields actually came up a little bit, whereas last week we can clearly see both the front end and the long end were looking at significant adjustment north of 3% apiece in a more dovish direction. So what was it that this data that we saw here? It came in exactly on the screws. Core inflation 3.1%, headline inflation 2.9%. Now, these were not sort of in absolute terms good figures in the sense that we're again above the Fed's target and moving ostensibly in the wrong direction. 2.9% would be the highest since January. 3.1% matches July, but that July was the highest since February. So you've essentially seen the core rate match a 5-month high and the headline rate set a new 7-month high. But I think the important thing for the markets here was that it wasn't worse than expected. It was right on expectations. If we look at the breakdown here, we can see we do get the rise from 2.7 to 2.9 on headline. We get the hold at 3.1 on core. The bulk of inflation, not surprisingly, still sitting in the service sector. But notably, the changes in the mix here start to get interesting. Let's step aside for a second and gloss over this rise in food because the Fed can't do much about the global cost of food, though, of course, there seems to be a tariff influence here. Certainly when you start to consider, for example, a 50% tariff on Brazil, the source of coffee, then things start to get interesting, especially considering that the U.S. actually has a trade surplus with Brazil, but not in coffee. And so maybe this is a part of that equation, though, of course, there's been a global rise in food prices more generally, and that's a part of this equation, too. On the energy front, things are basically unchanged. We're sort of hovering, and that echoes what we've seen in crude oil itself. This, however, is noteworthy because clearly services here are going in one direction and goods in another. And that may very well speak to an economy that's broadly weakening and straining under higher costs because, of course, services are where most people work. Services is by far the larger contributor to the economy than any other sector, and most of it is serviced by domestic firms. So this is supposed to be the largest component of inflation just because more economic activity is baked over here, but also this is where the consumers are, and this is where the tariffs are. And so this dichotomy here is certainly something to keep a close eye on. In fact, if we look not at the aggregate contributions, but at the change in those contributions, we can see core services actually saw disinflation in August. Goods rose again. We do get that slight rise in food, the slight rise in energy, and what seems to be occurring here, if we look at the trends, is a kind of sense that the good side is starting to get a little feisty. So on a monthly basis, as we can see from the top panel here, this is the third consecutive month that goods inflation has gone up. It's also gone up by the largest margin since January. So there does seem to be something of an escalation here. And then if we look at the year-on-year rate for goods inflation, that comes in at 1.49%, which is the highest since June of 2023. So we're looking at a more than 2-year high on goods inflation. Whereas services inflation, and that's the middle panel, that's been going down now for 2 months and has barely budged this time. Moreover, if we take a look at what's going on here year-on-year terms, we see that services inflation is really kind of anemic. It hasn't really gone anywhere in a few months. It's certainly rebounded somewhat from the kind of minor swing low in March of this year, but on the whole, since the beginning of the year, it hasn't really gone very far. It's kind of pinned around that 4%-ish rate. And so the story does seem to be shifting here, and the makeup of what's going on seems to be shifting. This didn't really have a material impact on Fed policy expectations for next week's meeting, and shock of shocks. As we can see here, yesterday we had a well over 90% chance that we're going to get one cut. We can see that that was the case a week ago as well, so we haven't had much movement here. Today we're a little bit more convinced that we're going to get that cut fractionally. Not really anything that makes or breaks the story, surely. We've gone from maybe 93% chance yesterday to 95 now. Not exactly a strong bit of additional conviction. If anything, we moved away from a 50 basis point cut slightly in the direction of a single move. So that's where we are for September. Today's data really doesn't create waves here. The larger issue continues to be the now increasingly building probability that there's going to be a third cut. So you can see here that while the Fed has only accounted for 50 basis points for this year, in fact has argued for that 50 basis points basically since December of last year, the market now is at 64 basis points. And that would essentially mean that we've gone 14 basis points beyond 50 in the direction of a third cut. Now, if we consider the likelihood here, this essentially means that a third cut this year is now slightly better than even odds at 56% chance. And if we start to kind of fiddle with adjusting for the dates of the meetings, the October meetings at the end of October, it's on the 29th. We're looking at that second cut there with a probability very convincing of 82%. And then for the December move, the likelihood of that third cut now is more convincing at about 77% once you kind of take the sequencing into account. So the markets have narrowly started to believe that a third cut is likelier than not. Moreover, for next year, the gap remains yawning. We've got 73 basis points on the menu, so kind of rounding errors aside, the market is looking for 3 cuts. This is now a much more dovish outlook on the whole than the Fed has actually accounted for. So here's the latest Fed forecast. We can see from 4.4, the median now, down to 3.9 gives us 50 basis points in cuts. Then for next year, down to 3.6 gives us 1 more cut. So the Fed has accounted for only 75 basis points between now and the end of next year, whereas the markets, again, as we can see right here, are aiming for almost double that. And so what we're looking at then is significant disappointment risk if the Fed doesn't come the market's way. And that perhaps starts to explain why the front end of the curve really didn't do anything today. Because this next Fed meeting isn't really the object of speculation. The question is what happens next. And with that in mind, there's one more piece of data that we have to contend with this week, and that'll be the University of Michigan Consumer Confidence Report. Now, the expectation is that we're going to get a little bit of a come down on all of the components here, including baseline sentiment, though that's expected to hold relatively better. The biggest drop-off here seems to be, at least as far as expectations go, that front-facing index here that looks at where consumers expect things to be heading. And this is really much more important, perhaps, than even the CPI report for Fed officials. It may not react that way in markets, we'll see, of course, but Fed officials have been pounding the table, screaming that they will not allow what they still think could be a one-off increase in inflation because of these tariffs to become entrenched and to take the Fed in a longer-term way off their target. In fact, with inflation now hovering around 3%, that the Fed is going to cut rates seems to necessarily say the Fed thinks inflation will recede. But they are not going to endorse an expansive easing cycle to follow if they think there is a risk that inflation is going to once again become sticky because consumers start to bake it into the cake beyond this shock downwind. Now, we already saw that basically this consumer sentiment index is a function of inflation expectations. In fact, it's been that way since we've come off of COVID. We can see here sentiment was deteriorating as inflation expectations were rising into the middle and the second half of 2021. This is where they peaked as the Fed clearly signaled we're going to start hiking rates to beat this inflation down. Once they really get to going on that, we start to see sentiment improving as inflation expectations come down. We ultimately get them down here to this low of 2.6. Then, of course, as the year begins, this is the start of this year, we get a surge in inflation expectations, and so not surprisingly, sentiment craters. The bottom in inflation is also a major turning point for sentiment. And that's, of course, having to do with these tariffs. Now, we see that once the tariff shock starts to abate, having peaked in April with Liberation Day and its immediate aftermath, sentiment starts to improve a bit. But the trend is down because inflation expectations are up. And we see that last month, or the last time that we got this survey, inflation expectations started to go up again because that pass-through of inflation costs that we saw in July's PPI data, it's a little bit different in August, margin squeeze took that number down. It's debatable whether that's a good thing as far as consumers are concerned. But at least for the moment, August's data told us consumers saw inflation expectations rising again, ostensibly because they saw that inflation coming and appearing on actual store shelves. And that was a move in sentiment lower across these indicators. So the question now likely to be, if inflation expectations jump and they keep going higher from the 4.8 that we just saw, does the Fed feel comfortable not so much in doing this cut, but in extrapolating forward still more of them next year especially? Because if the Fed sees that consumers are getting concerned, then it isn't going to compromise its credibility by allowing inflation to build, especially in expectations. In fact, this was the early tell in the second half of 2021 that the Fed was going to have to get off this inflation is a transitory thing song and dance and actually do some hiking. It was the appearance of inflation in these consumer inflation expectations that was the first tip-off that the Fed was wrong. And so when we look at this now, and sort of given how forceful the Fed has said we are not going to allow this to get sticky, not like last time, it seems like the path of least resistance is for the Fed to be cautious if this goes the wrong way. Now, we've done this over the past several days, but we'll do it again. Just how much easing is still on the menu is obviously a huge influence on price action. Because we can see here, since the beginning of the year, there's the spot where stocks, this is the S&P 500 here, take out their range and start to trend lower. As we can see, policy expectations move in tandem. They likewise bottom at the same time, as it appears that the White House has a sense of market discipline, and once they spook everybody from mid-February into early April with this tariff rollout being a growth risk, which is how you get the S&P 500 and policy expectations moving in the same direction. Once they sort of figure out that the markets think all of this is being done in a way that endangers the economy, they step back. The president says the bond market is getting yippy. There's a 90-day pause on tariffs, and the panic eases. Now, we can see the growth risk receding in policy expectations, But that stops here in mid-May. From there, we get more dovish. That also lines up very neatly with where we end up in stocks at the same time. We recover exactly to the same spot where the sell-off on growth grounds actually kicked off. Then, naturally, one has to wonder, well, what about the rest of this stocks rally? Well, it appears to be moving inversely with an increasingly dovish outlook on monetary policy. The idea that whatever risks you may be thinking about, valuation mismatches, AI hype running out of steam, 2 wars ongoing, whatever you like, uncertainty about the tariff regime as the Supreme Court weighs it, doesn't matter. Name your risk. There's no shortage of them. But all of those risks are much more digestible if money is cheaper. Because then if you get one of those things wrong and you lose some money, then it's cheaper to borrow it back and go again. So it isn't shocking, seemingly, that you have, with this increasingly dovish outlook, after whatever shock, and not on its grounds, but clearly for other reasons, that on this basis you have a building in risk sentiment. In fact, if it were for the same reasons, stocks would be going down at the same time, but they're clearly not. So the markets clearly think the easing is going to be risk positive. Now, if suddenly we end up with a situation where inflation expectations are doing the opposite of what the Fed said they're going to ensure is going to occur, well then, getting this forecast here for 75 basis points to look more like this forecast, almost double that, is probably not a strong sort of case to make for Fed officials. And ostensibly, they don't have to do it all at the same time. The markets will just need to see some movement in their direction. Let's say a forecasting of 50 basis points for next year instead of just 25. At least some momentum in the direction that the markets are attempting to pull Fed officials. But if that doesn't happen on inflation expectations, well, then maybe it doesn't happen. And then we have ourselves something of an issue. Because then some amount of this, whatever amount is contingent on this, looks wrong. And perhaps the dollar is sniffing that out already, because it hasn't made a new low since July, despite all of these dovish prognostications that were showing up in Fed funds futures and certainly empowering the markets as we see today. Now, a quick update on positioning here. Obviously, the S&P 500 broke higher today, so I took that position off at a small loss. We also had the surge in bonds today, and that was coming up on expiration, just 8 more days to go. So I took both of them off, and happily, the bond position made 3 times what the S&P position lost. So risk management worked there. I still have a little bit of exposure to the long side of the dollar as it continues to bottom. Clearly, the Aussie was not a case of that working today. So that was actually the more painful of the positions that I took off today. But so it goes, a little bit of a loss there, though we end up the day in positive overall because that bond position really did come together after almost 80 days of holding it. Then we still have a little bit of long exposure to Brazilian stocks, but this is a long-term thing aiming for year-end. Not much there. Still long gold, which didn't really hurt today either, but also didn't make a big run. And still a little bit risk off in those assets where there was no break like there was in the S&P. NASDAQ didn't take out its high, and Bitcoin didn't really make a concerted break out of its setup in the direction of maybe downside continuation either. So still have those. With that, we have macro money for today and this week. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Likewise, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back next week. Happy trading.
What is going on, everybody, and welcome back to another session of Risk and Reward. Today's Thursday, closer to the end of the week. We've had CPI this week. We've had PPI this week. How are we holding up so far, Gus? How are we doing?
Doing all right. UNH just keeps on pumping and keeping the portfolio afloat, and then Paramount Skydance just keeps on making good moves. I think that they said that they're looking to acquire Warner Brothers today, as I recall, but they're up big on that news. So the two, I would say, like highest risk profile trades I have on right now are UNH and Paramount Skydance. Both just naked calls, long-dated naked calls, and so both of those have been ripping, and it brought this week. Well, we're not at the end of the week yet, but they're bringing this week to a nice close for me if things can stay where they are.
Nice, love that for you. I'll live a little vicariously through you, especially on the UNH move there. But UNH still going strong. Hope everybody else is doing well. Hope everybody else is doing well in their UNH positions. Today we have a little bit more of an interesting topic today. We're going to touch on AI, of course. Not a surprise here, but some of the effects of AI, especially with the younger children. Was this a topic that you ever pondered on yourself, Gus? Just was seeing AI, recognizing certain tech that we didn't have as a young kid, seeing how we would have used some of the tech as a young kid if we had it then, but also we never really talk about the other side of things. So excited about this topic for today.
Yeah, I never really considered it in the context of children. I don't want to get too deep into my talking points for later here just yet. But I'd never considered it too deeply, specifically in the context of children. No, I'd obviously considered the dangers that these chatbots could have, and we've done whole segments before about how parasocial relationships are at an all-time high, and these streamers, children are really forming what they believe to be personal relationships with these streamers. But I never really stepped back and thought about it in the context of children. I'll be honest, I don't really think about the implications on children with most things. I am a 23-year-old single childless male, so the children usually aren't on the very forefront of my mind, but there are definitely dangers here, especially with how imaginative kids are, and it's an interesting topic and something I'm excited to get into.
Yeah, let's dive into the first
time where I agree with the government as well. We're about to talk about a rare time where I am going to say the government made a good move.
Yeah, no, I mean even pondering on the topic for today, I was thinking along the same lines pretty much. Like, we always hate when they have to step in some way, because I just think about how we're in a free market. So it's like you can produce the most amazing tech products that you can produce until it starts to hurt the masses for whatever reason. But an interesting angle to talk about it. So are chatbots dangerous for children? Let's get into the first slide. Take us away, guys.
Let's dive right in. So today the FTC announced that they are issuing orders to 7 high-profile companies. So we're going to outline those companies a little more deeply on the next slide about the potentially harmful effects of their chatbots, and more specifically, they want the FTC isn't directly investigating the harmful effects of these chatbots. They are instructing the companies themselves to internally investigate these things. Alphabet, Meta, OpenAI, XAI, and Snap, which is Snapchat, are among the companies named in the probe. Another one that was in there that I had heard of before, I've never used it myself, is called Character AI. I guess it's pretty popular among kids. You can pick different celebrities and people like that to talk to. I shouldn't even say pick celebrities. You can pick AI chatbots that are meant to emulate the speaking patterns of celebrities to talk to. The FTC is primarily concerned with the effects that human-like communication and interpersonal relationships may have on children and teenagers, childhood development, developing social skills. And this has, been a thing. We'll get into it a little bit more later, but, the interpersonal relationships have been on the rise as of late, and also in-person communication has been falling off for some years now, and that already is hurting childhood development skills. So it's interesting.
No, it is. And I forget who brought up this perspective one time, but I brought up the perspective about how there's going to be a lack of social skills being developed because of the fact that we have all this tech nowadays to not have to communicate as much as we used to. somebody brought up the point one time that some people are communicating more than they would have originally with the use of a lot of these tech and a lot of these tools that we have nowadays. I know we have things like Discord.
This was the discussion that you and I had, and I would bring up the same counterpoint here, which is that I think that communication is certainly at an all-time high, but I think the connection is kind of falling off with it, which is interesting.
That's a great point.
That's one way of looking at it. But yeah, I think that with the rise of digital communication, we are seeing personal connections sort of suffer as a result of that.
Yeah, very ironic considering the topic today, because some is making personal connections through tech. We'll jump into the second slide there.
It's true. And it absolutely can work the other way, too. I'm not sitting here to just talk down on technology. Last year, I went to a wedding of one of my gaming buddies that I've been playing with since I was 14. It was the first time I'd ever met him, and it's awesome. And that's something that a connection that I never would have made without technology.
Met them in real life.
Yeah. It was really, really cool. Yeah, flew up to Boston for it, whole thing. I'd known the guy like 8 years, but it was our first time ever actually, seeing each other in person, and it was for his wedding, and that's cool. That's a friend I never would have made if technology and digital communication did not exist. So it absolutely can work both ways. But and I'll elaborate more on this later. But it's like there's a reason. When you're in 6th grade, it's easier to text a girl to ask her out than it is to do it in person, and it's because face-to-face communication does carry some weight. It is that important. Lord of the Flies. I hate to give any credence to that book because I was so annoyed when I had to read it, but it's true. When you take the face-to-face element out of things, it hurts communication.
I mean, it sounds like the root of it is fear of rejection. Because if I think about it, fear of rejection can look like many different things. Can fear of rejection be like not getting the response that you hoped for? Missing the mark on your expectations, or you didn't get the reaction that you wanted, or the feedback that you want, or just whatever it might be. I know we'll get a little bit deeper into these topics as we ponder on these other bullet points. We'll go ahead and jump into the next slide and go from there. But the FTC wants to know what steps these companies have taken, if any. And that's one thing I was wondering. I was like, if these companies are going to investigate themselves, I might walk up in there too, we checked, we're all good, all clear. We're not doing anything that might be harmful. So protecting kids online is a top priority for the FTC, and so is fostering innovation in critical sectors of our economy. So that's where it gets kind of funny too. It's like, we got to be extremely creative, right, in a free market, but at the same time, it's like, it feels like there's now a little bit of guardrails there, and of course, going to have to step in whenever it's needed. But broadly, the FTC is worried that these companies are getting caught up in the chatbot race while not considering the negative consequences. Yes, that might be the case, but I would say that's the case for pretty much any founder in any literally almost every single industry. I would say this is the same type of human behavior that we typically see. But I just think that AI kind of cuts a little bit deeper than a lot of the other tech that we've originally seen.
Yeah, I think as time has gone on too, we've just gotten. I think you make a great point. I should lead with that. This absolutely happens in any industry, anything that's new and exciting and buzzing. These companies lean more and more towards not considering the consequences and only considering the future and the profits and all these things. But I think that we as a country and as a government have just gotten a lot better with time about jumping on that sooner and sooner and sooner when we can start to see it happen. Because we had you go back 100 years and Standard Oil is a monopoly and they got 8-year-olds working in the oil field and all this good stuff. And it took decades before anyone stepped up and was like, hey, we should maybe do something. The government should maybe step in because this is clearly a monopoly. And now, we're only a few years into the advent of AI here. And I would say only probably 2 years into chatbots being a super duper mainstream thing that everybody is consistently using on a daily basis, maybe less than that. And it's only a growing number of people. So I think that this is pretty fair timing for the FTC to step in. And it is very important to protect children. I agree. We should never be advocating for making profits and advancing the future of technology over children. So I'm with this decision for the FTC. Yeah, I think it's the right call.
Yeah, I know.
And especially with how accessible some of these things are and how low hanging it is. Like the Snapchat AI is crazy. That's been around for some years now. But I remember me in high school when that first popped up. I was like, who is this? Who is this person?
Snapchat AI.
Yeah, and I was pretty quickly able to figure out, it's Snapchat AI, whatever. But if you're 7 and you're on Snapchat, which 7-year-olds probably
might be like, "What's up, bro?"
Snapchat to begin with, but there absolutely are many out there who are. And all of a sudden, there's this person just talking to you that's incredibly agreeable and well-informed, and you might not even ever put those dots together. It might take you a while. So it's.
And to the point that T-Port made over here in the chat, he had just said that the human mind and the child's mind is a lot different. And I think especially with individuals that are in their 20s, especially after each year in your 20s, I think you start to recognize how much those younger years really do shape you. And I think you learn so much more about yourself as you get older too. Like, especially for myself, I know sometimes I'll do something and I'm like, whoa, that really reminded me of my dad. Or, oh, that really reminded me of my mom, whatever the case might be. But we're just so completely different. But when I really look back at these things, the things that were said, the environment that all of these things really shape your mind on a deeper level than you might realize as you get older.
Yeah, it is really funny, and I joke all the time, like I'll all of a sudden come to some broader realization about like my entire life or my childhood or why I act a certain way or a different person acts a certain way. I always say the joke like, oh man, my prefrontal cortex is finishing. Like I can tell that it's finishing developing. But I mean, for real, like as you progress through your early 20s, and that does actually happen, your prefrontal cortex actually does finish developing around that time. All of a sudden, I'm like, you know what? Maybe 21 is the right drinking age. Like maybe this is a really smart thing. Maybe, you know, it's all these things. Maybe we should raise the driving age to 18. That does seem to make a lot of sense to me. So, you know, funny little things like that. Bob, with positivity for Lord of the Flies. Look, I understand the nuance of Lord of the Flies and the psychological take that it has on human nature and everything. Just kind of felt like it was forced when I had to read it in high school. You know, like I felt like the whole book is like, I don't know. I like Great Gatsby more.
Honestly, all the books I read in high school.
American high school literature goes, I'm a Great Gatsby guy.
I don't know. Great Gatsby's fire. But no, I was going to say, you know what? All the books felt like it was forced. But I take that back. You know what? One book I really did enjoy. I don't know if you read it, but it was Hatchet.
Hatchet was fire.
That was a great book.
Middle school type vibe.
It wasn't.
That book was
I read it in middle school. I tried to sneak it in there, but it was middle school. Fire book. Fire plot.
Hatchet was excellent. I think I might have just read that for pleasure in like 5th or 6th grade. Actually, I don't know if that was ever a like sanctioned reading activity, but anyway,
we can jump to the next slide here.
Jumping over here. So here's what the FTC is specifically looking for as they dive into these investigations. They're seeking more information about how companies develop and monitor user engagement, develop and approve characters, use or share personal information, monitor and enforce compliance with company rules in terms of service, and then most critically, the point that we've been talking about this entire time, mitigate negative impacts to users, particularly children and teenagers. So that's just a quick synopsis there of the other things that they're looking at, which leads us into our final slide here, where we are going to raise these questions, and this is where I will actually start saying all of the things I've been saying I was pushing off until later, but I'll kick it to Errol for this slide first.
No, but I mean, are chatbots really dangerous to children? Children's social skills have deteriorated as digital communication and virtual interactions have grown more prominent, as we've seen in society. And if you're a parent, you might have seen these things firsthand. Interpersonal relationships are at an all-time high among children and adolescents. This is something that has always occurred within younger individuals. I remember even one of my younger siblings, one time I had said something about some play friend something, and it caught me off guard for a quick second. I was like, oh, this isn't just out of the movies. Like sometimes people develop and a week later, never heard of it again.
Imaginary friend. I'll step it. I had one. Absolutely. I'll talk about that later. You can go on. I had one.
Absolutely. When I seen that firsthand from my sister, I was like, oh, it really just gave me, it just reminded me how young and impressionable kids are. I think as we get so much older, we forget where we once grew from, and it made me just recognize how sensitive these minds are. I forget the point I was getting to, but let me finish these bullet points. Children are inherently imaginative and have underdeveloped critical thinking skills, which I would highlight as one of the most important bullet points. And then there are a growing number of adults that have formed uncomfortably close or even romantic relationships with chatbots. So younger individuals are more prone or more susceptible to being manipulated. And the question at large here is, can an AI, a chatbot, manipulate a child? In my opinion, absolutely. I think these are great issues to start having, great things to start investigating, because I see certain, I don't know if you've read these things, but even into adult years, these chatbot things can be very interesting. I think even with the adult mind, there are cases where these interpersonal relationships are also being developed. So if that's the case, we see that even with brains that are a lot older, above the age of 10, above the age of 20, it's like anything below that I think is even more impressionable if people are still building these interpersonal relationships with these type of tech.
Yeah, absolutely. Something that comes to mind right away here, I'll tell the imaginary friend story in a moment, but really weird comparison to make, but I think it's a really sharp one here, is Furbies. You remember Furbies? I don't know if Furbies are still around.
That is ringing a bell. That just struck a chord Help me
It was like
me
a little
remember.
talking stuffed animal thing, and you could talk to it, and it would talk back, but it had no intelligence or anything. It would kind of just say like generic pre-done lines, but it had like 100 lines saved in there. But you hand a 5-6-year-old a Furby, and they will think that that thing is alive. So I can only imagine what you're getting into when you have a full sentient, so to speak, chatbot that is communicating directly with you, is actually responding directly to what you say. That does get really dangerous. I mean, we've talked about on here before. When you're a kid, you think the stuff on TV is happening behind the TV.
Right. I thought WWE. I thought people were getting the SmackDown low key when I was young.
I thought Dora was happening in my living room behind the box. I'd be looking
Blue's Clues. I thought that
exactly.
thing,
Yeah. So you're talking about that level of critical thinking skills, and then suddenly you have to interpret. I couldn't even explain what's it called? LLM.
Large language models.
Large language model. I was looking for. I was going to say limited language. LLC. I guess. Anyway, LLM. Yeah, I can't even comprehend a large language model. I couldn't really effectively explain it to someone, or machine learning, or all of these things that go into creating these chatbots. So trying to explain that to a child, or even more exaggerated in the case where a child is trying to rationalize it themselves, I just don't think that that's going to compute. And as I said earlier, I had an imaginary friend when I was a kid. His name was Coyote. I don't know why that was his name, but it's a true story. And when I was like probably 3 or 4, I don't think he was really around anymore by the time he moved to Ohio, and I was like 4.5, 5 then. But when I was real young, I had an imaginary friend, and I totally, fully thought he was real. It was like not even a thing. It was like, this is a real person. Which, if an adult starts saying that, it's schizo. But when you're a kid,
everything's fine. It's cool. It's fine when you're a kid, but all of a sudden I get older, it ain't okay. People are asking if I need help.
You keep your imaginary friend until you're 25, and suddenly
it just shows I'm consistent and I'm loyal. I keep the same friends. I'm loyal. No, but it really it reminds me of not too long ago. I went to a baby shower. One of the kids there, he might have been 5 years old. I think I brought this up a few weeks ago. He might have been 5 years old. We were talking about the topic of AI and how real some of these things are. I think it was the bunnies jumping on the trampoline. I know all of y'all got. I know everybody in the chat section. I know we've seen the video of something on the trampoline and it's jumping and it looks real. We find out it's an AI video. We continue on this topic of AI, and I think he might have been 5 or 6, but he brings me his phone. First of all, crazy. 5 or 6 years old, has a cell phone to show me. Crazy. I know. Shows me the phone. It's a cat, and he's like, "Can you believe this is AI? Look how crazy AI is." And I'm like, "Yes, I absolutely can believe that's AI. It looks so fake, right?" But I just humored it a little bit. I was like, "Wow, that's crazy. AI is getting crazy." But just to see that in the moment, just again highlighted how innocent and naive the young mind is and these children are, because if he thought that was real, I just can't imagine and everything else that these AI models are producing nowadays. I mean, it looked like a drawing. I don't even know how to describe it. It just threw me so off. I also think that because we had that conversation, this is why children's minds are so complex. I think also it looked more real to him because he heard adults having a conversation that AI looks so real. So it's almost like he had to act as if this is so real as well. And I'm just like, what is going on in the brain? Does it now look more real to you? Does it not? Whatever the case is. But this did get my brain going and just thinking a lot after that incident.
Oh, absolutely. And bye, big deal. Have fun with your nephew, by the way. Meant to throw that one out there. Yes, but absolutely. Because this is only the chatbot side of things. I mean, this isn't even getting into images or, the broader social media picture, what children can stumble into there or see and believe is real. And man, I'll tell you what, I have seen recently, like in the last week, 2 videos where I had to get to the comment section before I fully realized that it was AI. Like I was sussed out because it seemed to be unrealistic, whatever was going on in the videos. And I went to the comments to confirm my